We're seeing upside surprises in the data.
The thing that we don't have is global growth.
You need to be data dependent. You need to see whether these dynamics actually play out.
The idea that this is all behind us in the economy, I don't think that's true at all.
It's far too early to say that recessions won't happen as a general rule. I think actually all the pain is probably still to come.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro in London and Lisa Abramowicz and Tom Keene in New York. Welcome on radio, on television to Contraction. What is it, Wednesday? Contraction Wednesday?
It's Contraction Thursday, I think. I think the GDP report comes out. Yeah, exactly.
My report, but the bottom line is GDP comes out today. It's going to be a good number, and that's it.
Well, again, we got 7 straight months of below 50 reads in the PMIs that we got yesterday. So what does that say in terms of what the growth is and whether that's already baked in?
It's an odd terminal screen today. Let's talk the data check, folks, before we go to John Ferro with a really important question in London. Yeah, futures negative 28, Dow futures negative 169, VIX under 20 shows some good news. But in the bond space, as they call it, it screams economic slowdown today, the real yield in, and look at the 2-year grind that we're seeing right now.
And this follows an auction yesterday that was actually important because it highlighted how much demand there was for the short
what does that signal?
Of the Treasury curve.
It drives me nuts. We're going to stop the show now and say, why did that auction matter?
It matters because it gives you a sense of whether people see value in the short end of interest rates at a time when some people are saying the Fed's going to have to go much further than a lot of people believe. So people are basically calling the Fed's bluff and saying, we see value there, we're going to go there. And to me, that's interesting and tells you the mood and how much people are willing to push back against the
Dollar
Fed.
churning. Jane Foley with Rabobank will be with John Ferro in London coming up here. And I'm looking at the 2-10 spread really got down, not to negative 80 beeps. What has come back this morning is the 10-year inflation-adjusted yield is, talk about space. It's in a new space, and it's a space of disinflation.
Disinflation seems to be the theme, although overnight we got a read from Australia for the last quarter of the year that inflation actually accelerated to the highest level in decades. So on one hand, yes. On the other, if you think about some of the economies that are most affected by China's reopening, are we getting a sense that perhaps things are starting to plateau at a higher pace?
Tesla this afternoon, we'll underplay that. But Microsoft yesterday afternoon, I think we got to drive that story forward. Up it was at 4 p.m.-ish, 5 p.m.-ish, and it ebbs away today on a little bit of azure concern.
Well, basically, their actual returns, their actual results were above expectations, but it was all about the guidance. And looking forward, the possibility of cloud computing and the growth there falling by 4 to 5 percentage points or 3 to 4 percentage points, still at a very high pace, but just concerns there about things coming off.
Futures negative 30. I want to get this, Lisa, and dash to the brief if we can. I really want to make clear we're seeing movement in the bond market that you need to focus on with the economic data today. The 2-year yield comes in 6 massive basis points, 4.15%. The 3.50 10 years now, 3.43. Even the 30-year bond plays in a bit, 3.59%. Inflation-adjusted yield, the one I look at, 1.15%. It would be shocking to see a 0.99% 10-year real yield. Lisa, we're not there yet.
Fighting the Fed seems to be the theme. Today, what I'm looking at, 10 a.m., we get the Bank of Canada rate decision, followed by an 11 a.m. press conference. This is interesting. Bank of Canada was ahead of the curve in terms of raising rates faster than other central banks last year. Are they going to be ahead of the curve in dropping down the pace of how much they hike rates? We have seen those 2-year yields over in Canada also plateau. 1 p.m., more auctions, U.S. selling $43 billion of 5-year notes. I do take a signal from how much demand there was yesterday for that 2-year yield. Do we get the same kind of read-through for this auction? And the earnings grind. Really, I can't say enough about how much the entire schedule this week leading into the GDP report tomorrow will be about earnings. Microsoft shares lower by 2.3%.
Really
Ebbing away after delivering strength in the actual earnings, but the guidance, everything. Today we get Tesla and IBM after the bell to continue with some of the tech. And before the bell, we're watching for Boeing, Hess, Freeport-McMoran, and Kimberly-Clark to get a read on toilet paper.
What we're doing, it's going to be interesting. We're going to watch some of those off the headlines, if you will, earnings report. We're also going to get a read on what's going on in London. Ferro starting the day, he's up at the crack of 10 a.m. I mean, that's, it's R&R for John Ferro in London. He's got one of our favorite guests with him this morning. John, what do you have?
Hey, Bramo, I'm not shaving. Yeah, I might leave this the whole week. I am waking up at about 6. I'm having a nice breakfast, going to the gym, seeing family, seeing friends. I'm making a good time of it.
I'm so jealous.
We're missing you, TK. We're missing you. Let's set the stage. Let's set the stage. We come into 2023. The consensus is pretty clear. The first half's going to be tough. We've got to pay the bill for the tightening of the last 12 months. Got it? Second half's going to be better. You get a recovery. The year starts, boom. Everyone's wrong. The Nasdaq 100's up about 8% year to date. The Stoxx 50, the Euro Stoxx 50 here in Europe is up about 9% year to date. Max Kettner of HSBC said, get on board. Max joins us now. Max, I have to say, once I knew I was coming to London for a week, you were the man I wanted to catch up with. That note from a couple of weeks ago, and I'll share the quote with our audience just in case they missed it. So you're bearish the whole of 22, super underweight, max underweight, then you said this to start 23. Having been staunch bears for much of 22, we think the consensus is wrong. We see a variety of reasons to be less bearish on risk assets in the first half. So let's talk about what you see so far. Do you like what you see so far?
So far, I think yes, but we've got to be honest and also say there has been some, some easing also on the bond side of things, right? So it's not just been cyclical strength, but it's also been strength on the bond side of things. So that has been taken pretty positively, I would say, by risk assets as well. That's part of the reason also why the Nasdaq was outperforming, why growth and tech stocks were outperforming. Now, I do think if we look at the consensus, right, I do think, look, we've got very pessimistic expectations. I think everyone is saying, look, earnings expectations are still too high. I don't disagree with that, but I disagree with the sequencing. I disagree with the timing, right? Because if we've got pretty much everyone agreeing that H1 is going to be tough, if we got, economists agreeing like they've never agreed before. Look at the Philadelphia Fed survey, right, on this recession probability. That's on like at the highest in 50 years. So we've got consensus agreeing on the probability of a recession, on the factors driving it, and on the timing. Now, what's the downside surprise then, right? What's the downside surprise to earnings? If you've seen in Q4 and now in Q1, those earnings revisions downwards, particularly in the cyclicals, in consumer discretionary, in materials, in the mega caps in IT and communication services. So exactly where we want to see them. What's the actual downside surprise? Now, I would argue, look, if we get an average recession, right, it's not going to blow anyone's boat, right? It's not going to be like, oh yeah, this is a massive surprise. This is why we need to get bearish now. No, not at all. Actually, what we need now is we need to get something properly going wrong, right? We need to have an accident, we need to have something break. Then you can be bearish.
You clearly thought it was upside risk. We've got a squeeze right now, that's clear. I'm trying to work out what are the durable tailwinds for this market. I get it. Everything you've said, a lot of people are on board with it. What's durable about what we're seeing?
I think it's still durable because sentiment and positioning is still so downbeat. I mean, let's not forget, we've just updated our sort of aggregate real money investor positioning study on Monday, and that still shows underweight positions on aggregate in equities and in high yield credit. That's normally not the case, right? That's historically been rarely the case that you see outright underweight positions. You see the same thing, right? If you look at CTA equity betas, they're still down. Yes, they've gone up a bit, but they're still, in level terms, still down. Look at equity betas of US equity funds, massively underweight. Multi-asset fund betas are sort of average. None of that is telling us, oh yeah, like everyone's already gone bullish. And if anything, when we talked to clients in the last sort of 2-3 weeks, the biggest pushback we got was, well, I know that everyone else is already bullish, therefore I have to continue to be bearish.
Right. Let's break this up, equities versus credit, and start with equities. Microsoft this morning, or rather after the close yesterday, how many messages did you get saying, look at Microsoft, you're wrong? What did you say back?
No, look, I mean, what I would say is it's not the time yet to go full on max overweight equities, right? With that, I agree. But that is mostly very, very tactical, because look at what's priced in for the Fed for the next 2 meetings. We've got less than 50 basis points priced into Fed funds now, cumulatively for the next 2 meetings. So they've just got to come out next week and say, look, we're going to go 25, but we'll do another 25 in March, right? They're going to guide us towards that. And even that would already be a slightly hawkish surprise. And that would weigh on high multiple tech stocks and so on, right? It would weigh on valuations again. Perhaps a bit of a higher rates vol, but a bit of higher real rates, and that means then weighing on multiples in tech. So very tactically, I don't like equities, I'm not massively bullish on equities just yet. I would say in a muddling through scenario, right, where you say, look, it's going to be neither here or there, right? We're muddling through in terms of growth. Slow grind lower rather than really a swoosh down and the recovery in H2. That means that credit, high yield credit is fine, emerging market debt is fine, IG debt is fine, right? All of that, you just churn over the carry. That's fine.
Well, let's talk about emerging markets and let's talk about credit. Emerging markets, I think it was Morgan Stanley Investment Management yesterday. Get on board. They're not alone. That's quickly becoming consensus. EM International outperforms. Can we talk about domestic US credit? Triple C's. Citi came out yesterday, and I have to say it was a nuanced report, but the headline is buy triple C's. How much risk do you want to take in credit? Do you want to go right to the bottom of the quality stack and get into high yield, into triple C's?
Yeah, I think that does make sense to an extent, right? If we look at triple B's versus single A's and we compare that against PMIs, there is actually much less weakness priced in. If you look at triple C's versus double B's, that looks much fairer priced relative to where macro indicators are. So there you could actually argue, well, the weakness is priced, particularly if you compare it, right, within the high yield. That weakness is pretty much in the price. So that's good, right? It'd be much worrying, I think, if we talk about the macro side of things as well. One of the pushbacks we got is, I remember we had our note down and people said, but look at the ISM, look at the services ISM, the new orders, it's 45.
Who wants to buy credit with sub 50 PMIs?
How can you turn more constructive now? My answer is very simple. I wouldn't turn constructive if it was still at 55 or 60, because then now leading indicators would still point down and we'd say, hey, we got another 10, 15 points lower. Be careful. Now you're at 45. I look at it, I'm like, well, this is exactly what I wanted to see. Done, right? Let's get on.
Max Kettner, you make it sound simple. It's not. We've got a challenging year ahead of HSBC. Max Kettner there of HSBC. TK, Max Kettner, bearish the whole of last year, comes into 23, gets constructive fast.
Well, a nice switch there. And again, it comes around to the earnings season, John, that we'll see. With Microsoft, it was fascinating, John, to see the lift yesterday, sigh of relief, and then a real question about cloud dynamics. Anurag Rana of Bloomberg was insistent they'll endure.
Wait for the guidance. Wait for the guidance. I heard that from Anurag Rana the whole of yesterday, Tom. We got the guidance and clearly a deceleration in growth. Tom, we've been piling into that growth story in cloud and Microsoft and elsewhere for a long time.
John,
now reality's starting to bite.
We need some guidance, John. When do you come home?
What on?
Are you coming home? We need some guidance.
I'm hoping perhaps over the weekend, maybe into Monday, but it depends. I'm enjoying this, Tom.
There, folks, is your forward guidance from John Ferro in London. Stay with us. Futures deteriorate. Negative 28. This is Bloomberg from London, from New York. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany will provide Ukraine with a significant upgrade in firepower to use against Russia. Now, Berlin has confirmed that it will initially supply the Ukrainians with 14 of its Leopard main battle tanks. The Biden administration is expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. In the UK, the government spending watchdog reportedly will cut forecasts for growth. According to The Times, the Office for Budget Responsibility told Chancellor Jeremy Hunt that it overestimated the prospects for medium-term growth. That will leave the government with a multi-billion-pound hole in its spending plan. Senate Majority Leader Chuck Schumer is telling Republicans, show us your plan. Schumer and other Democrats want the GOP to offer a proposal for raising the debt ceiling and avoiding a default. House Speaker Kevin McCarthy and other Republicans are demanding spending cuts in exchange for increasing the borrowing limit. A downbeat forecast for Microsoft. The software giant says revenue growth in its Azure cloud computing business will decelerate in the current period, and it warned of a further slowdown in corporate software sales. And shares in companies controlled by billionaire Gautam Adani are falling. Well-known U.S. activist investor Heidenberg Research said it was shorting the Empire stocks. Now, it accused the companies of brazen market manipulation and accounting fraud. Adani Group calls the Hindenburg report malicious and baseless. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Bloomberg Surveillance, John Ferro in London. We'll go to him here in a moment. Lisa Abramowicz and myself in New York Earnings Central right now. As we look back, we look now, we look forward. AT&T right now, who cares? I mean, it's Ma Bell. Time used to stand still. You're too young to remember this. It's like, oh my God, Ma Bell. No, let's start with that. Nobody cares anymore.
Well, the big industrials, the big sort of classic utility companies, whether they're going to be more important at a time of perhaps more stability. What I find interesting, they missed marginally when it came to certain aspects of their earnings, basically a wash. But the investment that they're planning for next year, the CapEx, increasing more than people expected. How much do you start to see that? Motley picture. I'm going to stick with that kind of theme for this earnings season.
We're going to have to see as well. And then Tesla this afternoon. I mean, it's not a small matter. Somehow TWTR, the former, will come up in a Tesla discussion.
Is Tesla a tech company? Is it a car company? How will it be valued? What will it be viewed as in terms of preceding what's to come, right? Is this a leading indicator for next week when we get some of the auto manufacturers, or is this a leading indicator for Amazon and Google and some of the other tech giants? I don't know exactly how it's being accounted for right now.
MoffettNathanson, you know them from their work in entertainment. Sterling and Billy over there just doing a great job on Microsoft. And they moments ago lowered their Microsoft target price. They tweak it down to 263 from a 268. That's the back and forth, if you will, we see in this nascent earnings season. Right now, on the greater economy, and particularly the European economy, with tanks being steered around, Neil Shearing joins us, writing exceptionally thoughtful notes for Capital Economics. Neil, good morning to you as well. We are coming up on a one-year anniversary of this war. What does year 2 look like? And what does year 2 of the war mean for Christine Lagarde?
Well, you're right. It's difficult to believe we're only a year in. It feels a lot longer, doesn't it? The key way that this is affecting Europe's economy, obviously, is through what's happening in terms of commodity prices, in particular gas prices. And really, the start of this year has been dominated by what's happening in China, rapid reopening there. We've had speeches from the Fed officials and others, and US inflation. What's crept under the radar, I think, is the fact that the European gas price has absolutely plummeted. Natural gas prices now a third of what they were almost 6 weeks ago. And so that, I think, is signalling the ECB's not out of the woods. Madame Lagarde's got more work to do and her colleagues have got more work to do, but their job has suddenly got a lot easier.
Do they have the nominal GDP spirit, if you will, to act like the Federal Reserve of the United States? I don't buy it. I just don't. I'm not convinced the disparate nations of her European experiment had the oomph to prosecute a Jay Powell method.
I think that's right. There's clearly, there's many more seats around the table. There's many more competing views around the table. And of course, immediately a lower natural gas price helps the inflation picture because it clearly reduces the price of natural gas. But that feeds back into the economy by supporting real income. So the demand picture further ahead starts to look a bit better. All other things being equal, that means the central bank has to push back against that. So that's why I say I don't think they're out the woods yet, and coalescing and coordinating that policy response, I think, is going to get difficult.
Neil, there's a lot of discussion about peak inflation, that perhaps the U.S. is past the peak and Europe is close to the peak. And then we got Australia overnight with inflation surpassing expectations and accelerating in the last 3 months of last year. Does that matter to you? Is that significant?
Well, it's significant insofar as what's happening in the Australian labour market, I think, is really interesting. It's a very tight labour market. So I think all along it's been obvious to most economists, at least looking at this, that the month-on-month gains in prices would start to ease. We're fixated on the year-on-year changes when we look at inflation, but it's the month-on-month that really matters. The base effects will get a lot more favourable as we head through this year. The year-on-year numbers will come down. What's happening in the labour market is key because that's what's driving wage pressures, and that's what really will affect wage inflation, price inflation 12, 18 months ahead. And that's why I think Australia is interesting. Very tight labour market. We're not seeing signs of kind of core pressures easing to the same extent there. That's what obviously the Fed will be concerned about. The ECB will be concerned about too, happening in the US and the Eurozone.
That's where I wanted to go. This question of how do we get a sense of the labor market and whether that strength in terms of wage gains is continuing and has legs. Do you feel like that's the case, or do you think that people are right to say that even that is really cooling off?
Well, I think the first point to make is that irrespective of what happens in the labour market, I think core inflation in the US, certainly, possibly Europe too, is going to come down this year just because core goods prices are coming down. Shelter is going to come down in the US too. The labour market's important for 24 and beyond. Actually, some of the indicators we're following, there's signs of hope. It looks like the labour market started to loosen a little. The quits rate's a key indicator that ticked up a bit in the last month, but has generally been on a downward trend. So I think there are some encouraging signs there, but you've got to dig pretty deep at the moment.
Neil, Capital Economics does some very thoughtful stuff. I'm going to call it more up at 40,000 or dare I say 60,000 feet. On a broad sense, it's been a pandemic recovery, a supply-side dynamic within monetary guessing, monetary theory, if you will. And we're supposed to shift back to something we knew or maybe move on to something original. Where are we right now in that movement from a pandemic-adjusted economy over to something quote-unquote normal?
I think there's two things happening here. The first is how does the pandemic fueled inflation surge play out? Can central banks get on top of it? Do we get back to something approximating the kind of Goldilocks era of 2% inflation, perhaps 3% nominal rates, real rates at the kind of 1% level, a bit lower? The economy that we were used to before. Yeah. I think probably we do get something like that. But like I say, central banks have got to really squeeze this inflation out of the system a bit further. The second, I think that the more tectonic shift is what's happening at a geopolitical level. The pandemic and events following the pandemic have masked this, but the splintering, the fracturing in the relationship between the US and China, that I think is deepening in many profound ways. We've got a flavour of that at this month Davos meeting. The IMF started to talk about it. That I think is going to shape the global economy over the next decade or so. It's a big story.
What's the big story here? And we're going to have a dearth of Fed speak, Neil Shearing, right now as we move to the February 1 meeting. They're in the quiet phase, so we're going to use you as our Fed speaker today. But the basic idea here is we've got to find economic growth, and that can be real GDP that somehow migrates back to a 3% run rate. Very few people are looking for that. Or a nominal GDP growth, which is all messed up with the current and present inflation. Do we go back to the great moderation, which everybody suggested was too subdued except for the haves? It was the only ones that were advantaged by it were the elite class.
Yes, I mean that question. I think there's two parts to, isn't there? There's to what extent is the pie growing and at what rate, and then how do you share that pie? Now, I think on the real side, on the real GDP side, I think it probably is likely that potential GDP growth in most advanced economies, I don't think it's really shifted. I don't think the dial on that has shifted. It's probably 1-ish in the UK. We're affected by labour supply problems here. It's higher in the US, but not much, kind of 1.5 to 2 maybe at a stretch. And then there's the inflation story. As I say, I think the maximum danger on inflation was perhaps 18 months ago when the Fed was talking about it being transitory. We were still talking about flexible average inflation targeting. Central banks were going a bit soft on inflation. Such has been the surge over the past 12 months that I think that argument has died a death. It's gone away. Central banks have been made aware of the primacy of their inflation targets, reminded of the pain they have to impart if the inflation genie gets out the bottle. So that's why I feel a bit more confident about inflation at a kind of 2.5 rates kind of further ahead.
Neil, before we let you go, you're talking a lot about the shift in narrative, and the narrative has swung wildly in the first 3 weeks of this year. We're heading into last year. It was Europe heading into recession, the U.S. faring a bit better, but it's going to be a rough first half. Now, all of a sudden, it's Europe is actually doing really well, and they're out of the woods. China's coming back online. It's going to fuel all sorts of growth. Has that narrative gotten ahead of itself?
I think it has. And I think expectations and starting points are the key point here. I mean, interestingly, in the US, you look at the data, it's fallen off a cliff. Some of the survey data yesterday was a bit better, but the leading economic indicators are falling sharply. In the Eurozone, it's improving, but from a much lower level. So I think some of this is just the fact that we came into the year with expectations in Europe particularly low and perhaps a bit too optimistic in the US. And we've had some normalization and adjustment. It's not necessarily that the US is underperforming Europe or Europe overperforming the US.
What's your China number here, real GDP, 12 months forward?
This year, and we have our own way of measuring China's GDP. We think it's about 5% this year on our own measure. There's going to be quite a rapid reopening and bounce, I think, in Q1, Q2, but then tapering, slowing quite sharply over the second half and back end of this year as those old problems come back.
Neil Sherry, lengthy, thank you so much. Greatly appreciate it with Capital Economics now. And look to his notes at Capital Economics. Really thoughtful stuff about, and I guess, Lisa, the way to put it is these three economic systems bouncing off each other. And I think of Bill Rhodes and central banker to the world. I'm not sure if Jerome Powell's, if he can be central banker to the world with the war in Ukraine and with a pandemic and perhaps in the Pacific Rim.
Well, it's a complicated world, and I'm glad that you mentioned the war in Ukraine because it does grind on. And we did just get this headline that the first German Leopard tanks are going to be deployed in Ukraine in 3 months. And this follows a lot of controversy in Germany about whether or not to join with the U.S. to send tanks over to Ukraine to protect the nation against Russia. I do think this is a pretty fraught discussion for a nation that has really tried to shy away from a lot of the military effort for, the past couple of years.
I don't have it in front of me, but someone who's been active in this discussion in the last number of days is someone that's actually been in a tank. Heaven forbid we actually speak to someone that knows what they're doing. And we've spoken to him before on the show, folks. Ben Hodges, General Hodges of the United States Army. And he, I just don't have it in front of me to do the full quote justice. But he says, look, you take these things and you move forward. It's not the movies.
Well,
things get out of the way.
There's a belief that there is a window of time for Ukraine to really make inroads before the spring, that the weather could be on their side and all of these things. The issue that I have is the war is still going on and the tail risks are still there. And this is really a huge effort on all sides to figure out how to grapple with it.
Now, we see that with the euro this morning. Really stasis here at a 109 on euro. Futures deteriorate down a good 0.8%, negative 30. NASDAQ futures negative 1.2%. Stay with us. Mr. Ferro in London with Jane Foley. Look for that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany have overcome a disagreement that threatened to fracture Allied unity. They've agreed to give their main battle tanks to Ukraine. Germany confirmed today that it will send 14 of its Leopard tanks to Ukraine, and eventually there will be more. And as you just heard, they will be sent out, deployed to Ukraine in about 3 months. Meanwhile, the Biden administration expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. In China, Lunar New Year travel and movie box offices are showing signs of recovery. In the first 4 days of the holiday, the number of trips was up over last year. Meanwhile, the number of movie tickets sold was higher than in 2019 before the pandemic. The Bank of England has headed off threat of a strike. It's agreed on a 3.5% pay hike for its 4,200 workers. The increase in the overall pay pot will be targeted at lower paid staff to protect them against the worst of the inflation squeeze. Google says the U.S. Justice Department is doubling down on a flawed argument by suing the company on antitrust grounds. Now, 8 states joined the federal government in calling for the breakup of the search giant's ad technology business. The suit claims Google has illegally monopolized the digital ad market. And one of the world's largest chip makers, Texas Instruments, has suffered its first sales decline since 2020. The company also gave a lukewarm forecast for the current quarter. Texas Instruments has the longest list of customers and broadest range of products in the industry, and that makes its projections an indicator of demand. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Most large corporations plan out their hiring and headcount a year, 2 years, 3 years in advance, and every year they then adjust. And I think what's happening is the weakness really became more pronounced, and concerns about corporate margins became more pronounced in the fourth quarter, right in the middle of that planning process. If you look at CEO confidence in the economy 6 months out, it's at an all-time low.
Drew Mattis, thank you so much with MetLife. Great to see Mr. Mattis yesterday. I thought he was very good about some of the optimistic trends that are out there. And again, it's a morning data check that suggests economic slowdown here. The yield space is really important. 4.15% yields coming in lower on the 2-year space. The 10-year was a 350. We're in all over 2 days, 7 basis points there, 3.43%. 2s, 10s gave me some major inversion yesterday afternoon. We come back a little bit, still a very large inversion, 72 basis points. And my headline is the inflation-adjusted 10-year yield just flat out grinds into a new lower real yield. John Ferro in London, Jane Foley to come up with him on foreign exchange, Lisa Abramowicz and Tom Keene here. And I want you to grab, whatever you're having. I'm having a Tang-free morning for those of you on radio. It's in a beautiful crystal clear cup. But you got to have your coffee because we're going to bore you to death right now. There's my Tang-free. And joining us is Senior Vice President, boring us to death, Mandeep Singh of Bloomberg Intelligence, who's truly excellent on when Washington decides tech is too big. He joins us this morning on a 150-page document that I was thunderstruck by. Mandeep, I'm not going to mince words. I go back to April 13th, 2007, just before the great financial crisis, where I fell off my chair when Google bought the ad business by buying DoubleClick. Take us back to 2007. What did Google wrought when they bought DoubleClick?
Well, basically, they integrated their product suite across the stack. So think of ad market as, supply-side platforms, demand-side platforms, and then you have an ad exchange in the middle. Google has products across the stack. And pretty much if you want to advertise on any of the Google properties, whether it's search, YouTube, maps, etc., your best bet is to use a Google ad exchange because that's how you are going to get the best, most targeted ads. And that's what the Department of Justice is laying out here in a very clear way, how they have used that acquisition. And look, they've added more products, more tuck-ins to kind of solidify that because that acquisition was geared towards the web era. Then you had the mobile era. And so Google consolidated that. But essentially, the case that they're making is why does Google need to be an ad exchange when they are one of the biggest publishers out there and they are one of the biggest demand-side platforms out there?
On a day of AT&T earnings, is this equivalent to a request to do a Ma Bell and do the breakup into 9X, Pac Bell, and the rest of it? I mean, is that all we're talking about? Is Google says, okay, we're too big, we're going to divest, and of course they take a huge equity interest in DDM.
Well, so it's not that simple. With internet businesses, and again, I'm going to mention network effects and scale. It's all about that. And the way you get it is, by integrating things across the stack. I mean, even, Apple, that's what they've done for their App Store and how it integrates so closely with their hardware. So essentially, you could argue that the ad exchange piece can be divested. But I don't think it's that simple in terms of taking out a product and spinning out a separate company. There is a lot more nuance to it, and that's where it'll be challenged.
Lisa, are you dozing off yet?
Actually, I think that this is actually a really fascinating issue because if you take a step back, at a time when we're getting technology earnings, we're hearing from the Department of Justice, which doesn't want to just fine Google, just slap them on the wrist. They want to have them do a divestiture of a major business model. Where is the growth going to come from in the technology sphere, given that the Department of Justice seems a bit more concerned about antitrust issues at this point?
Yeah, so Lisa, I think even in the call last night from Microsoft, cloud continues, especially the infrastructure side, continues to grow very well, 30% plus growth. Yes, it's going to decelerate a little bit from, above 35% to low 30s, but it's still very strong. And if there is any resilient piece in the IT spend, that's the one I think every company is targeting, even Google for that matter. They're trying to build their cloud business. And that's where you're going to see companies continue to spend on AI, and all these trends are feeding into that cloud infrastructure spend.
Given that, Mandeep, can you give us a sense of what your takeaway yesterday was from Microsoft's warning of some softening growth in the Azure, in the cloud computing unit, and what to expect from Intel, what to expect from IBM, what to expect from some of the other tech giants that are set to report earnings the next few days?
Yes, a pretty bad read-through for the PC market. I mean, Windows OEM revenue was down 40%. So if that's any indicator, we're not in for a quick rebound. At least that's the read-through from the consumer side, the PC side of Microsoft's results. And the Azure deceleration, I still think they're a little bit conservative in their guide. They have tough comparisons. That's what makes it tough to keep growing, 40% plus, but it's still the resilient piece. The productivity apps is coming down because you're seeing these tech layoffs, and it's a user subscription driven model. So that's where you will see some deceleration. But look, Microsoft is still indispensable to enterprise IT. And, if they are seeing a slowdown, that will have a read through for pretty much all the software vendors out there.
Right. Mandeep, let's go back to United States of America v. Microsoft Corporation. I was sitting somewhere here at Fortress Bloomberg, and all of a sudden they dropped the litigation, the effort to break up or rip apart or tear apart Microsoft. Why is this any different? They're going to go on for 2 years, 3 years, 5 years, dare I say a decade, and then in exhaustion, one form of new political Washington's going to walk away from going after Alphabet A to Z.
It could very well happen, Tom. And look, this is not new. Google has been fined multiple times. I think what it kind of creates a situation for Google is, one, they can't make any new acquisitions, and they have to sort of create a level playing field. They're trying to do that with the deprecation of cookies, even on their Android ecosystem. They're trying to make sure that every ad tech platform has a fair chance in terms of bidding for the ads on their platform. And those are the kind of things, the remedies, that is what you're going to get
remedies?
out of it,
We need a lawsuit. We need United States of America against Apple, and they need to remedy the fact that within 3 weeks, you always lose one of your AirPod thingies. That would help more. Mandeep Singh, thank you for the clinic there on Google. This is a raging debate. Lisa, you and I don't agree on this. You think this is a big deal. I think it's just comical nuisance against the jewels of America, which is our technical superiority versus the rest of the world.
There's a question about whether you're crimping, and it is really truly a debate, crimping innovation with tech giants hoovering up all of these small competitors before
they did when
really
they hoovered up DoubleClick in 2007.
Right.
That's what they did.
That's exactly the issue. And so if the Department of Justice wants to stop that, these sort of cash cows to be able to go in and just sort of take anyone who's a competitor in order to foster innovation, does it foster innovation? Does that indicate that there's going to be a different kind of spending? There is a bigger significance to this, especially at a time where this is one of the questions. Where's the growth going to come from going forward?
I'm going to do a compare and contrast here, which I think is really, really important. Brian Moynihan at Bank of America, in any conversation, he's a true banking nerd, lines up what Bank of America is doing with their cajillions of profits to help the cities, the towns, the programs across this nation of a huge part of this nation flat on their back. I don't see tech doing that. That, to me, is the heart of the matter.
That's a great point.
Did I do okay there?
Actually, I think that's an excellent point, because if you talk with the bankers, they're investing, how many billions of dollars in issues with climate change and other issues that, you can be cynical all you want. It is to try to create a better impression after a really negative impression of the banking sector for a number of years. Is tech going to be required to do some similar types of investments?
They don't want to.
Some similar types of PR outreaches.
They're not going to make PR outreaches to that. They don't want to do it.
Whether they want to or not.
They're special and different out in Silicon Valley.
Until the DOJ starts going after them. Until suddenly you start to get fines. Until suddenly you have to have more of a lobbying effort. And that really, you actually raise a really good question. Are they going to have to put more muscle into that?
Where the hell's Ferro to sit between us and adjudicate these matters?
He's going to sit like on a stool right here. I think he's very happily not shaving and waking up at 6 a.m.
What do you think? I'm getting a lot of mail.
No, you're not. You're absolutely not getting a lot of mail. What, people want you to have a beard?
They say go full wolf.
How long would it take you to grow a full wolf?
a man like me, 2-3 days, something like that. Folks,
that's
I didn't
dreadful.
shave 5 days a week until I was like 43 or something. That was great. Mandeep saying we're never going to do that again. Thank you so much with Bloomberg Intelligence. Futures at -34. Should you be in the stock market? Next, Binky Chada.
We're seeing upside surprises in the data.
The thing that we don't have is global growth.
You need to be data dependent. You need to see whether these dynamics actually play out.
The idea that this is all behind us in the economy, I don't think that's true at all.
It's far too early to say that recessions won't happen as a general rule. I think actually all the pain is probably still to come.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
We're seeing upside surprises in the data.
The thing that we don't have is global growth.
You need to be data dependent. You need to see whether these dynamics actually play out.
The idea that this is all behind us in the economy, I don't think that's true at all.
It's far too early to say that recessions won't happen as a general rule. I think actually all the pain is probably still to come.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Bloomberg Surveillance, John Ferro in London. We'll go to him in a moment here. Lisa Abramowicz and Tom Keene in New York. Economic contraction is out there. We are going to push against that here in a number of minutes. For those of you optimistic, for those of you that say over my dead body, Binky Chada will be with us here in a moment. And Lisa, to frame this out, some real caution on the screen this morning.
Well, caution in the earnings, and I think the earnings this week are the highlight as people get a sense of what's actually going on the ground. The big debate that I keep hearing is what's priced in and what's not, right? Microsoft coming out, better than expected earnings, the look ahead, a little bit disappointing.
Well, that's Microsoft, and then the others will come out. But to what you and I talked about yesterday with Minnesota mining, it's away from the names that we all love and follow, and I'm really interested in how industrial America reacts. Julian Emanuel had a really important point. Now, excuse me, it was Tyler Radke at Citigroup, where he said Microsoft is doing what you do. You cut your operating expenses. You cut your CapEx down in a time of stress.
Microsoft is one example, and that's among the big tech behemoths. But the 3Ms of the world cutting 2,500 people, the idea that you're getting, it's a very different kind of comparison that's a little bit perhaps more hinged to the real economy.
I look at the markets here, and the big change for me this morning is a real bet on a disinflation. The 2-year yield in 4.15%, down substantially. We're not on the 3.99 watch yet, but we're getting there. What's a signal to you, Lisa?
A lot of people are looking at the real inflation right now and saying it's already fallen to 2%. If you take a look at December inflation, and there's a huge raging debate, does it matter? I mean, 1 month doesn't make a trend, right? 3 months might be the real issue. And that's why I'm really curious about Australia and the wage inflation and the fact that inflation accelerated in the last 3 months of last year, pushing against some of this past peak inflation. It's over. Go home. You're good.
Go home. We need reporting on this, and we're going to do that Friday evening, Manchester City against Arsenal. John Ferro will be reporting for us Friday evening and joins us right now. Is Man City the only company that can beat Arsenal? I mean, that's what this reporting's about.
Are you suggesting, Tom, that's why I'm here?
No, it's a set of games you're there.
City Arsenal.
Yeah. That's going to be
I'll tell you what I'm interested in right now, Tom.
Please.
It's not the football, it's the data. It's the economic data relative to expectations and relative to different places. So let's start with the United States. If you look at the economic data relative to expectations, the surprise index starting to roll over. Compare that to Europe, starting to inflect higher even more so. And that trend in Europe actually started last summer. So, Tom, when you push that through the market, think about foreign exchange for obvious reasons. Look at the bond market too. Take the German 10-year US spread. Look at the gap starting to close. And I think that's my my question for 2023. To what degree, to what extent can we close that gap even more? The ECB hiking interest rates last year, Tom, to 250. The Fed gets to 450. The ECB this year expected to play catch up.
But I'm seeing different series, including the real yield, John. You'll remember that program. I look at the real yield coming in, and the bottom line to me is this an economic slowness, not contraction, but slowness that forces the attention of the central banks. To me, that's the February question.
It forces the attention of the Federal Reserve. Right now, I think the question of January at the moment, Tom, is just a green light for this ECB to keep on hiking. We got that from German business confidence this morning. My question, TK, and I keep going back to it. I asked Max Kettner about this about an hour ago on this programme. Are there durable tailwinds to this Europe story? Is this just about a positive surprise, a readjustment in the probability that they go into recession, and then what? And the then what is pretty interesting. There's a big difference, Tom, between recession and stagnation and recovery. So we've parked recession, we're talking about stagnation. Now compare stagnation with the prospect of a real expansion in Europe. I don't think anyone's looking for the latter just yet.
Yeah, I totally agree with that on the expansion in Europe. It's just, we got to wait to see the data on that. John Ferro with Jane Foley here in a bit will be an important conversation on foreign exchange. On foreign exchange, I got churned to the market here with the euro 109. Yen really off the radar after the follies of the last 10 days at 129.74 yen. Sterling, Ferro at a 123 it's enough to get him to Manchester City on Friday. It's going to be, seriously, that's going to be an exceptional game. Tell me about what we got in the brief.
Just real quick here, 10 a.m. we get the Bank of Canada rate decision. Curious because they tend to be a front runner of what happens at both the Bank of England as well as the Federal Reserve. 1 p.m. we get the U.S. selling $43 billion of 5-year notes. Yesterday's demand for 2-year notes, very strong. Do we get the same for 5 years?
Going to come in.
It's people who want to own this debt because they think it is of value with the yields where they are. So this, to me, is a fascinating moment, considering that a lot of people are saying the Fed's going to push back against the market expectations. And earnings very much in focus for me. Tesla and IBM after the bell. We have Dan Ives saying that the Tesla earnings will be the Super Bowl of the earnings season. We have Microsoft shares lower and continuing to inflect lower throughout the morning, down 2.8% after disappointing guidance. And we heard there from Mandeep Singh that perhaps they're being overly conservative about their expectations of growth in their cloud computing business, but showing the importance of that Azure platform of cloud computing in general for big tech.
Let's get to it. If you're in Global Wall Street, this is without question your interview of the day. If you need to be optimistic, there's no better place to be than at Deutsche Bank with their chief global strategist and head of asset allocation, Vikram Chadha. Mr. Chadha has made clear he is enthusiastic, and as it hasn't happened, he's simply moved his timeline out. We get an update this morning from Binky Chadha. Binky, you're at 4,500, 4,400, 4,600. Nobody believes you. You've never been this lonely in your storied career. Give us the x-axis. When's the timeline when Chadha Nirvana happens?
So actually what we have in terms of our outlook for this year is really the rally in Q1, which we think of as basically a continuation of the rally that began late last year. I wouldn't necessarily describe it as, sort of a bullish view on fundamentals. The basic driver of the rally, in our view, is really a positioning squeeze. As we know, since late April of last year, it's all really been about the central banks. And if you look at our measures of positioning, the fundamental investors, we call them the discretionary equity investors, very quickly moved down to neutral to slightly negative. What got squeezed as a result of the last 6 months of last year is really systematic strategies. Systematic strategies tend to follow the market. So to have this big divide between systematic strategies, 2 Z-scores below neutral, let alone where they most of the time...
I flunked that on the CFA exam. Binky, let me cut to the chase. Ralph Ankapour in Technical Analysis is adamant we made an October low in the Dow Jones Industrial Average. He's as bullish as you are. Mm-hmm. So there's a short squeeze. We're squeezing out the gloom. I get that. Yeah. What's the then what after we squeeze out the gloom for you and Mr. Ankapour?
So, we have our year-end target, which, yes, I understand it looks bullish. I would say it's only a little bit more than 10% up from where we've been recently. We see most of that happening basically in Q1. And then we have basically, as you know, a call for a recession in the U.S. Starting in Q3. So second quarter, keeping in line with the recession playbook historically. We have the market going sideways, so that's still 4,500. We have, if the recession happens in Q3, a pretty severe sell-off, which would take us all the way down to 3,250. But I think, very important aspect of the recession playbook to keep in mind if you're thinking out 12 months is that equities, pretty robustly bottom about halfway through. So if you have a 2-quarter recession, they will come all the way back basically in Q4. And so my Q1 target is my year-end target. Yeah.
You said something pretty radical, that it's all been about the Fed. It is not necessarily about some of these other issues, like earnings, which we keep getting and a lot of people keep looking at.
Sure.
So how do you push back against that? And how much do you expect tech to continue to lead, regardless of the up or the down, because of that macro play?
Yeah. So tactically, our call is to be, the rally will be led by tech and the financials and some of the consumer cyclicals where, priced in 120% of an average recession. I think it starts to make things pretty asymmetric. I'm sorry, I lost the last part of the question.
But this is an issue because right now we're looking to.
I do the same thing. Don't say you're sorry.
What, just because of me? No, this is an interesting issue because right now I'm watching earnings and people are saying there's a real fundamental shift underneath the market, that you have tech that's not necessarily going to lead in growth, even though they now are leading in returns just simply because of cuts, et cetera. And I'm wondering whether you see that, whether we're heading back to a different normal in terms of leadership or whether we're heading back to the same regime. It's just sort of dependent on the Fed.
So, in terms of earnings, for the year as a whole, if you put in a recession in there like we have, we're talking about $195. So the question is, what happens if the alternative, which is a very popular question given the market price action, and it's more likely to go sideways and even to start to recover. I think in terms of thinking about earnings, everybody talks always about growth rates. I think it's also important to keep in mind where the levels are. Equity valuations come off of levels. And earnings have been running, sort of well above trend levels, and so we have this issue where I mean, even if you looked at real activity, the good side of the economy, it's essentially been going sideways for 2 years now.
We're out of time, Binky, at 4,500 on SPX, and what Mr. Chadha just said there, Lisa, is religion to me. Which is it financial TV is addicted to change, movement, stay with us. Microsoft right now down under 236, that kind of stuff. He's looking at levels. And this is the bathtub story. You're looking at the water coming in and out of the bathtub, or you're looking at the level. Olivier Blanchard in his new monograph is on the same page in economics as Bikram Chadha in equities. Levels matter. The levels, the scale, the mass of Microsoft matters.
Yeah, and that's the reason why you have a real battle right now of how disappointing some of the guidance was, or was it not at all? They're still seeing a lot of growth. They're still rolling off cash at a time when, this is still something that gives them a lot of power.
I mean, it's outrageous. We've got a modeled out 12 months Microsoft free cash flow of $75 billion.
I mean, this
$75,000 million.
They don't do that anymore. People messaged me and said, please correct TK. We don't say that anymore. It is clumsy. It is inefficient.
Was that enough optimism for you from Mr. Chadha?
It's interesting. It's actually not that optimistic compared to other people now.
Come on, he's going up to 4,500.
But that's only for the first. It's the same as the year end. It's going to be all in the first quarter, then it's going to be chopped.
Oh, come on. David Folkers-Landau called up Chadha and said, my deepest sympathies. We'll leave it there. At Deutsche Bank. Binky Chadha, thank you. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany will provide Ukraine with a significant upgrade in firepower to use against Russia. Berlin has confirmed that it will initially supply the Ukrainians with 14 of its Leopard main battle tanks. The first German tanks will deploy to Ukraine in 3 months. The Biden administration is expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. In the UK, the government spending watchdog reportedly will cut forecasts for growth. According to The Times, the Office for Budget Responsibility told Chancellor Jeremy Hunt that it overestimated the prospects for medium-term growth. That will leave the government with a multi-billion-pound hole in its spending plan. Senate Majority Leader Chuck Schumer is telling Republicans, show us your plan. Schumer and other Democrats want the GOP to offer a proposal for raising the debt ceiling and avoiding a default. House Speaker Kevin McCarthy and other Republicans are demanding spending cuts in exchange for increasing the borrowing limit. AT&T forecasts profit and free cash flow for this year that missed estimates. It's another signal that high costs are hurting prospects for the wireless industry. Mobile growth was better than expected, with AT&T adding 650,000 new subscribers. A downbeat forecast from Microsoft. The software giant says revenue growth in its Azure cloud computing business will decelerate in the current period, and it warned of a further slowdown in corporate software sales. Meanwhile, Microsoft has resolved widespread problems with its online services, including Outlook and Teams. The company said the problems were due to a recent alteration to its network configuration. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
For 15 years, Google has pursued a course of anti-competitive conduct that has allowed it to halt the rise of rival technologies, manipulate auction mechanics to insulate itself from competition, and force advertisers and publishers to use its tools. In so doing, Google has engaged in exclusionary conduct to severely weaken, if not destroy, competition in the ad tech industry.
Good morning, everyone. The Attorney General of the United States, Merrick Garland there. Thank you to Mandeep Singh for giving us perspective there on this lawsuit. Lisa, final word there on the lawsuit. What do you think?
If this is actually a harder line from the Department of Justice, does that indicate that you're going to see some spending from big tech go elsewhere? And what does that mean in terms of other tech giants?
And this is your academic, so I don't think I'm going to catch you unawares. If we get a Republican president or a Republican this or a Republican that, does the suit change? I don't know.
The Department of Justice usually is somewhat insulated from the politics, but the follow-on suits probably will be, the expectation of them will be less, right? I mean, that's typically the Republicans would come out with less of an antitrust kind of thrust than the Democrats, and that's what a lot of people would be expecting.
One of the charms of Anne-Marie Horton, our chief Washington correspondent, is real-world experience, particularly in Europe, and over to Moscow over the recent years, and we're thrilled that she could join us right now. Anne-Marie, on the tanks, have you ever been in one of these tanks? I can just see you out in some junket with a helmet on. No. Have you ever been in one of these tanks?
No, I have not.
I am dazzled.
Send me.
I'm dazzled by the technology lead, clearly superior to what the Russians have as well. General Hodges, Ben Hodges, has been out briefing with his expertise in the Army with actual knowledge. What can they do? Like, if they get them on the ground and they have a range of a diesel engine of 200 miles every fill up, I mean, do they just move forward? Is that the belief?
Well, that's definitely why Ukraine wants them, right? They want to be able to not just hold the line in eastern Ukraine and be able to get ahead of what they think is going to be a spring offensive by Russia, but they want to make those inroads into eastern Ukraine and get back that land that Russia has occupied and has been holding. I think the main point you made, Tom, was that these tanks are far more superior than the Russian tanks. I don't know the ins and outs. I'm not a tank expert and haven't been in one, but they have thermal imaging. I mean, they're incredibly high tech, and they have been used all over the world. These are the tanks that have shown up in Kosovo. These are the tanks that have showed up in Afghanistan. I think the main point is that these are the tanks that Ukraine believes they need to continue fighting this offensive and to make inroads really in this offensive. And the fact of the matter is once again, you have seen the West unite. Germany was pretty direct. We will not send Leopards if there's no Abrams. And now you're getting both.
We're getting both in the British tanks, I believe. Let me ask you, Maria, a question today. Why doesn't this just expand down to an advance of the superior hardware on Crimea? To me, the Crimea is the unspoken story here that we can get out front on. Is that part of the story?
Well, there was reporting recently from the New York Times about U.S. officials are maybe warming up to Ukraine looking at potentially having an offensive in Crimea or using weaponry to make inroads in Crimea. Crimea obviously is a little bit different when you're looking at the fighting that's going on, because Russia has held Crimea since 2014. Really, the new fighting has been more in eastern Ukraine and mainland Ukraine. Towards Kiev.
But Anne-Marie, why has this been such a controversial push? These tanks, in particular from Germany, have been incredibly contested within the nation. What's behind that?
Well, Robert Habeck, the vice chancellor, also the economy minister, told us on Bloomberg that they do not want to act alone. And then he made a reference to, obviously, we have lessened our defense because of our historical past. This is a huge reversal for Germany. This is literally like moving a tank for them. It is a U-turn in terms of their energy policy, in terms of their defense policy, and Germany does not want to be the ones that provoke Russia alone. So for them to make this move, they wanted to make sure the United States was on board. The U.S. argument is that the Abrams are much more sophisticated, much more difficult to operate. They do consume a ton of fuel. They have a jet engine in them. And they are just not as logistically feasible as moving them to Ukraine as it would be the Leopards. But Germany was very clear. In order for us to do this, we need the U.S. to act alongside with us. But the whole theme is that they are concerned about provoking Russia. They want this conflict to maintain, this war, to be within Ukraine. They do not want this spreading to NATO nations.
So where has the psychology shifted in terms of what an escalation is?
It's a great question. What the Kremlin has said in return to this announcement of the more tanks, the NATO weaponry going to Ukraine, is that they will just be destroyed as all other military hardware has been in Ukraine. That's what Dmitry Peskov has said. But when you hear from Medvedev, who recently was talking on Telegram about all of this, he is talking about the fact that he is prepared, or Russia is preparing for a prolonged war because of the weaponry that the U.S. is going to send to Ukraine. So it does seem that Russia potentially is going to view this as the West is not backing down. Even if critics say they drag their feet, and I spoke to Ukrainians, I recently spoke to Yuri Sak, who's an advisor to the defense minister. He was here in the United States about these exact conversations. When are you going to send the tanks?
Right.
Russia is getting the signal that they also need to prepare for a longer, protracted war.
Emery, thank you so much. Greatly appreciated. Emery Horton with a brief there on tanks. Learned a lot there here on what we're doing with the Abrams, the Leopard of Germany, and, of course, the British tanks as well. There are a set of headlines here which have something to do with Bramo's kids trading at the opening yesterday. They swamped the exchange. I get one report, it was 80 stocks. I get another report, it was 200-some stocks.
Yeah.
And the key thing is they have algorithms that come up with a first price at 9:30, and that didn't happen.
Well, and what happened yesterday at the opening bell of the New York Stock Exchange was bread and butter stocks, McDonald's, Wells Fargo plunged by billions of dollars in market value, and then were halted, and the volatility
Morgan Stanley
was
went down
tremendous.
13%.
Exactly,
Yeah.
and it raised a question. Okay, what's going on here? Is it somebody jamming the system? Is this just a complete glitch in the system? Right now, New York Stock Exchange is saying that there's a short sale restriction that's going to be lifted in a subset of symbols, and that some short selling restrictions were wrongly triggered yesterday. There are a lot of issues here, Tom, but to me, how vulnerable is a system that has more volume getting pumped through it? And what's the potential liability? Is this just a glitch? They didn't necessarily honor some of the trades, so it wasn't necessarily that money was completely lost. But there are some real questions stemming from this.
It'll be interesting to see how they mop up people that took advantage of this in a constructive way versus people that, you know, is an amateur sense, I would say, were nefarious, because it's not like the crash of '87 where we didn't know for 3 or 5 days what we owned and what we didn't own. This is the micro speed that we're all going at today with no spreads.
Is it enough for the New York Stock Exchange to come out and say, our bad, sorry, we'll fix it? Or is there something greater that's going to be required in order to create some sort of credibility and make sure that this doesn't happen again? Because this has been a big concern, the vulnerability of split-second trading and huge volumes that are trading on that. What happens if there's a glitch? What happens if there's a hacking? What happens with cybersecurity? I mean, all of these issues that people have been raising, does this sort of raise the ante a little bit?
Can I ask simply why this doesn't happen more often? Are we just, almost like the FAA and the plane computers of a week ago where the nation was shut down with flying? I mean, we're all slaves to these computers. That's all there is to it.
Well, that's a great question, right?
Did I do okay there?
That was good. No, it's true. That's the glass half full side of things that perhaps,
Well,
we should be impressed that it doesn't happen more often.
ICE called me last night. They own the New York Stock Exchange. And I said, well, look, if you're in the triple leveraged all cash fund, this wouldn't happen. I mean, that's all there.
How's that working out?
You wake up, you look at LIBOR, and you go back to sleep. Stay with us. Negative 32 on futures. Bloomberg Surveillance from London, from New York this morning. In Washington are Jennifer Jacobs and Anne-Marie Horton confirming frontrunner status and top contender status of the Vice Chairman of the Federal Reserve, Lael Brainerd, to be considered to advise the President in the position now held by Brian Deese. This will be most political, leaving a senior and, Lisa, I would say different Vice Chairman post at the Fed. Lael Brainerd as Vice Chairman is different than Richard Clarida as Vice Chairman.
Lael Brainerd was number 2 at the Federal Reserve. She is number 2, and she's been pushing back on the margins against this feeling that the Fed has to go much further, and is talking about the balance of risks to the downside in terms of economic pain. So what does that do if she leaves, and who replaces her? And then there's also the questions of some of the political interference that some people are going to raise.
It becomes a new debate, but she's going, if she was to go back, and the Washington Post was suggesting that the Secretary of Commerce, Gina Raimondo, maybe has said she doesn't want to do that. That's speculation at this time. But Jacobs and Horton are reporting here on someone who is comfortable with policy, working with Bill Clinton on the same council as a very young academic out of Wesleyan. I believe she was teaching at MIT at the time. I don't recall that. But I would really suggest that policy is where she's more comfortable than worrying about dynamic stochastic general equilibrium theory.
Whatever you want to say about her, she is a very respected academic mind and policy mind. So people might get a lot of support behind her, even though, perhaps there are going to be questions around the Fed leadership and who replaces her and what that means for the Federal Reserve.
Brainerd is front runner to run the Biden Economic Council. On the data front, a deterioration through the morning. Microsoft leading that deterioration after up nicely. Negative 33 on SPX, with Microsoft visiting 236, even 235. Yields come in. John Farrell making note of that from London. There's just simply no question about that. It is earnings season. Quickly, Lisa, on individual names.
Yeah, well, I just want to tell you this, that Boeing just crossed, and their fourth quarter adjusted free cash flow is $3.13 billion versus an estimate of $2.89 billion. So just to give you a sense, we are getting a motley picture. I keep going back to this, with a lot of companies talking about pretty good earnings, at least so far, although with a bit of a softer picture ahead. Microsoft, key among those yesterday, saying that they are expecting a bit of a deceleration in the growth in the Azure platform. Those shares lower by 2.4%, gaining back from some of the lows earlier this morning. Tesla shares down 1.1% ahead of earnings later today. A lot of people looking not only about Tesla's sales, why they've been discounting their vehicles, but also, will Elon Musk talk about the next phase in the Twitter saga? When he steps down, who's going to replace him? And AT&T came out. This, to me, is oddly interesting, because AT&T actually gave a disappointing forecast going forward. And this follows on what we heard from Verizon yesterday. And yet the shares are up 2.3%, which raises this question of how much bad news has already been baked in. How much pessimism has already been established in the levels of certain names?
Well, we'll have to see on that. I would say the shock to me, as the shock is to anybody worldwide who follows aviation, like John Farrow, is to see that the headline from the Boeing company is out of Arlington, Virginia. That will be a shock across all of my youth into middle age. From Seattle to Chicago to outside Washington. That describes the travel experience of John Ferro over the last number of weeks. He joins us now with a really important conversation with Jane Foley.
Thank you, TK. I have to say the travel's been pretty smooth over the last week or so. Maybe I've been lucky. Let's frame the last 12 months. This is important. We've been wrestling worldwide with inflation, and central banks have made a move. The ECB's gone to 250. The Bank of England's gone to 350. The Federal Reserve has gone to 450. The Bank of Japan, the BOJ, has done absolutely nothing. Is that going to change this year? Jane Foley of Rabobank alongside us in the beating heart of foreign exchange. Jane, fantastic to catch up with you. Let's start there. Sub-zero at the BOJ. Is that going to change this year?
You know, it might, but it might not. And I think that's the really crucial point here, because if we saw, the meeting in January, we saw speculators all egging on for a change in yield curve control. And what do they get? Nothing. And I think this is the risk. The market's now assuming that we're going to get a replacement for Kuroda in April, of course, as he steps back. And they're assuming that we're going to get maybe a significant change in policy. We might get a change in policy, but it may not be significant. And that's the point. We might get another tweak to yield curve control. We may get an interest rate hike. We may not. Because if you look at the time frame for the Bank of Japan, they're probably not going to be hiking interest rates next year when, for instance, the Fed could be easing and other central banks. So you've got a limited time frame. But then you look at the fundamentals. At the fundamentals, yes, inflation is above its target, but only because import prices are not because it's domestically generated, which is the golden goose for the Bank of Japan. And if Kuroda gets replaced, there's a very good chance that he gets replaced maybe by one of his deputies, maybe by somebody else from the Bank of Japan, all of which have been supportive of the very accommodative policies for a long time. So disappointment could be coming.
Well, let's pick up on what you just said as the replacement. I think that's what gets everyone's attention, the fact that we have this final meeting with Kuroda in March and then the handoff in April. Which chalice carries the most poison? Does Governor Kuroda hand over a policy already set on a path to move away from yield curve control and towards higher interest rates, or does he hand over what there is right now? Which chalice carries the most poison?
I think it depends on the outcome of the spring wage rounds, really. And the indicators are that, yes, the spring wage rounds are going to bring some moderate increase in domestically generated inflation, wage inflation, which is what they wanted to see. And, that could lay the framework for a change in yield curve control and another tweak. Will it lay the framework for a change in interest rate policy? Well, that's a little bit further down the line. I don't think we can make that decision yet. But, the Kuroda might be leading the Bank of Japan, but he leads it with a whole board. And that board won't necessarily be changed that much. So I think there is not going to be this massive change towards a very hawkish central bank. You may get a slightly less dovish central bank.
The perspective within the BOJ was that this was perhaps a once-in-a-generation opportunity to reset inflation expectations higher. He's been doing this now for 10 years. I think we all remember when he took this on back in 2013. Does he walk away with any success whatsoever?
I think there is some success. Again, that harks back to the whole Peter Pan issue, the whole psychological issue that he thought that if you bring in an inflation target, people would assume that inflation might be higher and they would alter their spending behaviour accordingly. But as we know, that really has taken a very long time. But, with inflation around the globe, this perhaps has given a little bit of an impetus into inflation. So there is a little bit here. You've got the government of the Bank of Japan behind Kuroda. You've got the Prime Minister saying to firms, yeah, guys, you need to raise wages, and therefore you get what they're looking for, which is this virtuous circle behind higher wages, higher domestic demand, higher profitability, etc. And there are some glimmers of optimism that this might be coming, but I don't think there's a huge amount of confidence that they're there yet, hence the cautious tone.
You've implied there could be some disappointment. Dollar yen's come back from 150, sub 130, about 129 right now. Push that through the FX market for me. Where does that leave dollar yen?
I think we could still see 128 in 3 months. Of course, we are assuming, of course, the dollar is weak, and that's perhaps a large part of that movement back from 150. So, 128 is possible. Like I say, there is the possibility of another movement, another tweak in yield curve control, maybe some indication that they could move away from that in the months ahead. But the problem is, again, is that the window of opportunity is quite short. So 128 is possible, maybe even 126 in the middle of the year. But I don't think we're going to be, falling hugely in dollar yen beyond.
You mentioned the US dollar. I remember Tom, Lisa and I sitting here with you maybe in September. I think it was back end of September we were looking at cable at 103.50. Strong dollar. Euro dollar 95 something. strong dollar. It's all backed away since then. I think it's been a 10, 11% move on DXY. I'm sitting here this week trying to work out what's durable about all of this, particularly for euro dollar. I know there is a positive surprise. I know that we've got that adjustment as we move away from the risk of recession. What's durable about these tailwinds that we're seeing start to build?
Well, you know, I think this is really particularly interesting when you come to the euro part of euro dollar, because, you know, the market has now priced in a much better situation than it was supposed to be. We were supposed to be in recession for Germany, and now we've got the Scholz, the Chancellor last week, saying no recession for Germany. We've got the governors of the Bank of France, the governors of the Bank of Italy saying, yeah, you know, our outlooks are improving. You look at the performance of European stocks this year relative to US, so that the market has been buying into this far better than expected story for Europe. And we've got euro dollar, you know, touching this week at 109. I think the big question is how much of that is priced in and how much further can the euro sort of dine out on that story? Because, you know, it looked this week at the PMIs. The PMIs were like, oh, you know, they're not really that good. There are still headwinds coming. And as we move into certainly into the summer and the autumn, we could have another phase of the energy crisis. We don't know how cold next winter is going to be. So there are still headwinds facing the euro. And the market now is quite long of the euro. So don't think it's going to be that easy to push up to another leg. But of course, a crucial element of this is the dollar, and will the market continue to disbelieve the Fed guidance about the interest rate outlook for this year?
So I've asked this question 3 times this week. Maybe you've heard me ask it. Let's make it 4. Who hikes more this year, the Fed or the ECB?
I have heard you ask that, and I have heard the answers, and I think you know what I'm going to say too, because it's the same as everybody else. You know, the ECB is likely to hike more, but the question really is that in the price now or not?
It's 4 for 4, but that's an important question, that's for sure. Jane Foley of Rabobank, fantastic to catch up with you here in London. TK, these are really, really important questions for this continent, for Europe, and for that single market, for the euro dollar.
Well, it singles, John, the year ahead uncertainty. I like your idea. We ought to do our year ahead outlook on March 31. I know you're beginning to dive into yours right now. Yeah, we'll have to see.
I'll share my outlook a little bit later this week, Tom, but I agree with you. It always resets a few weeks into the year. Why don't they just wait? Why don't they just wait to launch their annual?
Because
I don't know.
We're members of the media. John Ferro, thank you so much.
They got us out. I get it.
On a great day there with St. Paul's. For those of you on radio, St. Paul's mired and missed. As his opinion of the theoretical physics, a PhD from New York University, Marko Kolanovic speaks, Lisa. We're channeling John Ferro right now, and you know, we could speak about Marko Kolanovic trying to extricate himself as an Uber bull of last year.
Well, the fascinating thing, he's gone a complete 180, right? He went Uber bull and now he's Uber bear. He's basically saying that people are ignoring the fact that fundamentals are deteriorating even as people are rallying behind stocks. And so, you know, at what point is he a contrarian indicator? And at what point is he really onto something? Because that fundamental data is sending a message that's different to some of the enthusiasm that we're seeing in other instruments.
It's a huge lesson for all of you watching and listening here, the distinction of how Marko Kolanovic approaches this versus Binky Chadha is starkly different in the level of certitude. And when Binky finesses it out, it's going to happen. We're going to get optimism out there, where Marco's trying to be more abrupt, more stochastic about his call.
Facts have changed on the ground, and so he has changed, but he's changed in the opposite direction of everybody else, and this is fascinating to me.
Futures -32. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany have overcome a disagreement that threatened to fracture Allied unity. They've agreed to give their main battle tanks to Ukraine. Germany confirmed today that it will send 14 of its Leopard tanks to Ukraine, and eventually there will be more. Meanwhile, the Biden administration is expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. In China, Lunar New Year travel and movie box offices are showing signs of recovery. In the first 4 days of the holiday, the number of trips was over last year. Meanwhile, the number of movie tickets sold was higher in 2019 before the pandemic. Google says the U.S. Justice Department is doubling down on a flawed argument by suing the company on antitrust grounds. 8 states joined the federal government in calling for the breakup of the search giant's ad technology business. The suit claims Google has illegally monopolized the digital ad market. Rupert Murdoch is dropping plans to recombine Fox and News Corp. In a letter to both companies, he said that combining the two media giants that he controls isn't optimal for investors. The controversial deal aimed to reunite the parents of Fox News and the Fox broadcast business with the print operation that includes the Wall Street Journal, the New York Post, and HarperCollins. And the UK's Antitrust Agency has kicked off the first stage of an inquiry into chipmaker Broadcom's proposed $61 billion takeover of cloud computing company VMware. The transaction marked the biggest ever takeover for a semiconductor maker. The European Union is also looking into the deal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Cutbacks have actually rewarded stocks over these last several months, but there's a finite aspect to that because, when you look at the way reports are coming in, there's only so much you can do to massage your bottom line if your top line's decelerating.
That's an interesting conversation. Julian Emanuel working with Edward Hyman there on the equity markets. I can't say enough about his day-to-day report of earnings season. We protect the copyright of our guests. You can get that from Evercore ISI. But Julian Emanuel making real clear corporations will adapt, and wrapped around that is Ed Hyman's call of significant disinflation to move under 3%. Futures negative 33, Dow futures negative 225. VIX nudges up above 20. Lisa and I are noticing here in the fixed income space some real idea of a slowing economy, as witnessed by a 2-year yield now to 4 digits, 4.1353. We're not yet on the 3.99 watch on the 2-year yield, but that's come in with an 8 basis point vengeance, to say the least. William McDonough is founder. He's chief executive officer. They've got a bunch of other titles for him at Element Funds. What he is one of the wisest people across a span of this thing called wealth management, is managing money and really, really trying hard to do the hardest thing, which is not lose money. We are thrilled that William McDonough can join us today. It's wrapped around Tesla. It's wrapped around what Mr. Musk is doing in these historic Muskian times, but there's about 8 other things to talk about as well. Will, thank you for joining us. You really center in your research note that the Tesla cars are a Trojan horse. Many people agree with you on that. What is Mr. Musk really up to?
Well, let's look back to 2006 when Musk really kicked this thing off, and his kind of opening mandate for the company was build a sports car, use the money to build an affordable car, use the money to build a more affordable car, and provide zero emissions power generations options to the world. He's following that. We need to listen to what he said. And I think what we're going to see from Tesla when they report today, we might not see Musk. I think they're starting to realize that maybe he isn't the optimal person to do the SEC communications, much like Apple did with Steve Jobs back in the day. Let's throw a black turtleneck on this guy. Let's put him on stage. Let's talk about the Cybertruck. Let's stop all these communications with regulators. That ain't his highest and best use.
I love that view of Tim Cook. Basically, how much can you put him into the background?
That's not a grab down and coddle. Continue.
Will, when you say a Trojan horse for the EV, for the battery, is this a positive for the stock or a negative when you look at its longer-term market share and potential?
Well, I was interested in what Julian just said, and I think there's a broader war on Wall Street right now and a juxtaposition between the top line and the bottom line. Like, what are we being judged by these days? We just came out of an environment where it was growth at all costs. I don't care what it costs to acquire a user, get the user. And then the tide went out and we saw that probably wasn't the right way to approach it. And now people are repositioning their thoughts around, well, what's the bottom line? What's the revenue? What's the EBITDA? And when you look at a company like Tesla, there's no justification for it being a $1.2 trillion company. We have our perspectives on why that happened, which I'll share. But when you really look at their numbers, they have less revenue than GM, than Ford, than Volkswagen, than BMW, but they have 8 times the market cap of Ford and GM. So what are we really doing here? What are we really looking at? We think investors play Tesla as a vehicle to get exposure to EV adoption. But what our business charge, our ticker on the New York Stock Exchange, allows people to do is just buy the base metals that are required for all EV, all solar, and all wind.
Well, but Will, then what are you looking for in today's Tesla earnings? Because it sounds like you've got a very strong belief. There are a lot of questions people are going to be asking about the discounts that recently Elon Musk and Tesla instated in some of the vehicles. What are you looking for to inform how much you amp up your view?
Yeah, I think that they're going to put their toe in the water a bit today. I don't believe that they're going to come heavy. You know, they have announced that in March they're going to do their first investor day, and they're going to brand that. There has been talks that they're going to launch their own investor platform that's going to allow for them to engage directly with their investors, much like you've seen Musk do with Twitter, polling, do you think I should be CEO or not? I think you're going to see more engagement directly with the investors. The investors feel like they're doing what they want to do. But if I'm Tesla and I'm on the board of Tesla,
right,
as I alluded to, I'm putting him back in his corner and saying, go stand next to the semi truck and let us report the numbers. And then let's do the fancy stuff and the exciting stuff in March.
Well, I got 8 ways to go here. And to get you on here on Tesla and Musk is interesting. I want to go to your experience, not only with Bob Diamond, and we thank Bob Diamond so much for coming on recently on the death of Scott Minerd, but I want to talk to you, Will, about your stance in Florida and your management of people's money, celebrity management, and that, in this thing called crypto. The Bitcoin losses have been taken, but far more the upset of crypto right now, which is tarred and feathered, I believe, one of your clients over the years, Mr. Brady, who throws footballs in Tampa. Tell me about the McDonough view on crypto.
Well, I think what happened in crypto in the last kind of 100 days is net positive for the industry because it flushed out a lot of the centralized players. It flushed out a lot of the unregulated players, which crypto needs to have a barbell approach to success. It needs to have pure decentralization that allows people globally to interact with it in a fair way. And then it also needs to have a heavily regulated on-ramp that allows investors and allows scale to come into the space and trust who their counterparties are. And I think if both of those things are accomplished, blockchain has no end.
How does the United States use a regulatory reach internationally given the criminal allegations within crypto?
The U.S. is the on-ramp for all global financial systems, right? I mean, let's just admit it. The volumes that come in through the U.S. markets, the volumes that trade on the U.S. exchanges, this is where the money comes from. Even if it isn't sourced here, it's managed here. And so this is the on-ramp to crypto. That's how they can control it, is by saying we control how you get money into the system and out of the system. And then the good thing about these blockchains is that they're very easily auditable. And so once you're on that system and we know who you were coming in, I can track what you do while you're in there.
Right.
And then I can see you come back out.
But do you have any, with your immense, international perspective here, your work at Goldman Sachs over the years, et cetera, William, I'm absolutely fascinated how a guy like you feels Department of Justice or SEC can fix the international regulation conundrum of crypto. How do you envision them moving forward?
I think they need to do it just like they've done any other industry over the last 100 years. You got to punch it right in the face and you got to address it and embrace it and really get to know it and understand it. Some of the times they've come out with statements have just shown that they actually truly don't understand the underlying.
Right.
When I believe that the majority of the real players in crypto embrace that regulation because they know that that will open up those floodgates for that institutional capital. And so they just need to really get people around the table that know what they're talking about and put some regulation in place that brings comfort.
To be clear here, Will, Bitcoin 15 to 23,000, are you considering it's appropriate in a portfolio today?
I always do. I think Bitcoin's trading at year end was somewhat driven around the fact that people tax loss harvest into the new year and they realize that they can put a little bit away. People don't realize that Bitcoin isn't subject to wash rules. So there's a lot of trading like that occurs. And then you've seen a lot of people leaning in here in Q1 because the FTX stuff and a lot of bad stuff flushed out in Q4. I'm not sure how much bad news can continue to come.
Will, thank you so much. Very candid there. William McDonough with us from Element Funds today. Lisa, I think it's just a huge conundrum. I mean, there are optimists on crypto, as Mr. McDonough, and that's his track record, is he's been a real optimist on Bitcoin, which is great. But what do our government regulators do about, and I'm just picking these countries out of a hat, folks. I did this. I used to play, did you play Risk as a kid? 3 on 2.
My kids play that.
4 on 5, whatever.
They used to.
Kazakhstan, Turkey, all of Eastern Europe, on and on, China, and the rest of it. Well, how do they reach out to that? I haven't figured that out yet.
Well, and how much do you get some sort of unified system in these different nations that can't agree on anything in order to come up with some consistency on inter-border kind of payments, which is one of the main targets for a lot of the crypto world?
What do we see on earnings right now? I mean, I know we got 25 companies, I believe.
There are a lot of interesting, interesting
Boeing
stories.
is always interesting.
Boeing is interesting, and the shares, I believe, are lower after they had a couple of disappointments. They're down about 1.7%. Kimberly-Clark, I find this really interesting. They actually were fine when it comes to profit, but sales came up shy, which is perhaps part of the reason why they're declining. But Forex, cutting operating profit this year by $300 to $400 million.
Thank you so much for bringing it up. The breakout I'm seeing is 4% is the new 2%. It's a hit. I mean, it was a strong dollar hit. We'll see which way that cuts with a weaker dollar. DXY 102 right now. Please stay with us. Lisa Abramowicz in New York. John Ferro in London. He has an important investment conversation coming up. Stay with us.
This feared recession, the food and energy crisis, which was so talked about last year, is just turning out to be less threatening than expected.
I think, yes, there's a potential that we see a little bit of an uptick in commodity prices.
Maybe the debate shouldn't be, are we going to have a recession? Maybe we actually should be having a debate, are we in a recession?
What will matter is that we don't think the Fed's going to be cutting this year.
Right.
We also think inflation is going to be sticky.
I think we end the year lower, but not a lot lower because we don't see that economic collapse recession scenario.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Welcome back. Good morning. This is Bloomberg Surveillance on Bloomberg Radio, on Bloomberg Television. Tom Keene in New York, John Ferro in London, Lisa Abramowicz here in New York as well. The earnings parade grinding on ahead of the storm, which is next week's Fed meeting.
It's the next week's Fed meeting, but far more. I hope the Vice Chairman Brainerd will show up. Anne-Marie Horton and Jennifer Jacobs reporting she is considered for a White House position. But what's important to me is a real whiff this morning of true economic contraction. I don't want to say recession, contraction, slowdown. I'm looking at the fixed income market, and it's saying to 4 digits, 2-year yield sluggish, 4.1373%.
7 consecutive composite PMI reads in the U.S. below 50, basically in contraction period. You do see these earnings coming in with softness in the expectation going forward. You do see a lot of signs of this deceleration, but is it enough at a time when you still do have that persistence, particularly when it comes to wages?
In this hour, we get the first look, fourth quarter GDP.
I believe that's tomorrow.
Tomorrow, my fault. We get mortgage applications coming up here and saw them, and they were pretty tepid here off of what we saw in the previous month. And then tomorrow, we get the enthusiasm of 2.6% Q4 GDP. That seems like long ago and far away.
Exactly, which is why a lot of people are looking to some of this anecdotal data. The leading economic indicators, a huge raging debate on Twitter about whether we're already back to 2% inflation based on the ongoing data. And that perhaps is what's feeding into what you're seeing in the bond market.
Oil finally pulls back. A dash to 90 didn't happen. We're taking a pause. Maybe it's an economic contraction pause. We'll have to see from there. Why don't you do a data check here to keep it going with Bitcoin, 23,000. I thought Will McDonough was really interesting there.
A lot of people have
enthusiasm
optimism
on Bitcoin,
on the idea that you haven't necessarily seen the incredible implosion that you might have seen if you really did believe that it was going to get deflated by regulation. We're seeing softness after a bit of gains to start the year. S&P lower by 0.8%, 39.98. You have a euro a little bit softer than the dollar. Again, though, a lot of people optimistic on the euro region, 108.78. The 10-year yield and the 2-year yield is where you're focused, Tom.
Right,
and you're right to do so with yields coming in 34.21 for that 10-year
In the
yield.
breakfast you and I had, I mean, you had the avocado toast to go with the egg over easy, and I had, I'm trying to be healthy, folks. It was a bowl oatmeal, and we moved on. I had a berry. I didn't have berries.
No, just one berry. Is that
just
your
one
diet?
berry. Others are not having a bowl of oatmeal and berries. They're having fagotini au champagne, trésor de bois, pulp marron et madere. Oh, that must mean John Ferro is in London restauranting as he goes, and he joins us now after the souffle Suesses.
You're killing me. This morning, for what it's worth, porridge with milk, Tom, some berries on the side. I shared that with you. Bit of scrambled egg. Just getting the diet, gearing up for the summer a little bit later.
Oh, it's a restaurant on the way back from Fulham. I get it.
I'm not going to touch that story. Here's a story for you. I've got a gentleman next to me who is short Amazon and long Apple. That's the lead. Let's pick it up with Patrick Armstrong, the Chief Investment Officer at Plurimi Wealth. Patrick, let's start there. Sure. You are short Amazon. I'm looking at Microsoft down this morning by 2.8%. What do you take away from that feeds this short of yours?
Yeah, I think over the last 9 months, the cloud business of all the big cap tech companies have been incredible, growing at 50%, falling to 40%, and then Microsoft's actually lowered guidance a little bit, maybe expecting great growth, but not crazy growth. And I think that's where cloud is going to. It's definitely a growth industry. I still think there's a bit of pricing in that you are going to have 40% compounding growth for a few years, and it's not going to happen. So the cloud business is where Amazon gets all its earnings. Its retail business is what everyone thinks about it. It's not even generating any meaningful earnings there. So it's a company that's expensive. Apple's a company that's mildly expensive, but I still think there might be a bit of multiple compression as more reality gets priced into the cloud out of Amazon.
Is there a decision that could be made in the C-suite that would make that short painful for you? What could that decision look like?
I don't think they can really do it. I think if you really change the pricing structure in Amazon where they price their retail goods to get a realistic and profit margin that can be sustainable in the future and generate outsized returns on equities, we're not in the pricing environment to do that. We're not in a period where companies are going to be getting expanding margins. So I think Amazon's going to do that. They've disrupted retail, but they've really not profited from it yet. I think at a time when we go into an economic upswing is the time they'll do that. And I wouldn't want to be short Amazon forever, but for the current market environment, the multiple it trades at, and we've still got quantitative tightening, we've still got a hiking Fed. Expensive companies are going to remain under pressure.
They doubled their workforce from 2019 through the pandemic. Meta did the same thing. Meta cut its workforce by 13%. Are we not going to see the same thing at Amazon? Is it just a different kind of business that doesn't have that option?
Well, they're going to be cutting. They've even admitted it. They've overbuilt their distribution. They've overhired. So they've started to make not meaningful redundancies, but they've indicated there's going to be some. So there's going to be more of that, almost certainly. They're overstaffed. Technology is overstaffed. Amazon's got a more real-world component to it than most tech companies. So I don't think it'll be the same magnitude as cuts elsewhere, but it is something that they probably are overstaffed.
Every tech firm you look at right now is making those cuts.
Yeah.
Amazon, Microsoft, Alphabet, take your pick. Apart from Apple, we're not seeing that take place at Apple. You are long that name. That name has suffered a little bit towards the end of the year. Walk me through why you're still long that name.
So when you look at the multiple, look at the defendable profit margins and China reopening, China was a big risk for Apple, and I think we're not past that. But having China zero COVID was a big risk to the manufacturing, big risk to the consumption out of Apple products in China, and I think we are moving past that. And it's trading at a multiple that's not cheap versus the MSCI World, but it's a dominant company with really sustainable profitability. It's got ongoing revenues now from not just selling merchandise, but subscriber fees, those kind of things. I think it's an attractive multiple for a dominant market position.
It's got the recurring revenue stream. I just wondered to what extent some of this revenue story is challenged by the economic conditions of the moment. How challenged is it? And are we going to start to see maybe that upgrade cycle just face some headwinds through the next several quarters?
I think it will be facing headwinds. The consumer environment's not strong. We've not seen any meaningful change in the employment situation. You're still seeing wages rising, still seeing companies basically trying to fill job openings. But the hikes we're getting from all central banks, they have a lagged impact, and they're designed to create unemployment, designed to reduce demand. So the consumer is going to not be a tailwind. But the companies that do have dominant market positions have a product that's not a commodity, I think can defend those margins. And I think Apple fits into that along with luxury companies. The high-end consumer is well-placed. Low-end mass market consumer, I think, is going to face some difficulty.
Let's talk about the high-end consumer. Bank of America put out a note in the last week or so, and they're discussing the prospect of a white-collar recession, that maybe you won't find the resiliency where you used to find it. What would you say back to that?
I'm not sure where the recession is going to come from. I do think it's going to be a broad-based consumer slowdown driven by a slowing economy. We're not in probably the worst economic outlook that maybe we feared a few months ago, but things aren't good. The U.S. is on the cusp of a recession. A minor recession or a shallow recession is probably where it gets to, but consumer demand will remain relatively robust because people who want to work can find jobs. They are getting pay rises. The amount of debt is high. Where the redundancies come from, I think it is going to be pretty mixed. But the highest end consumer, mortgage costs, food costs, energy costs don't matter to them. So the really luxury consumer, I think, is where you want to be selling to, because all the things that are pulling the purse strings of everyone in the world aren't impacting the mass market or the luxury consumer.
You say things aren't good. In Europe, things aren't good. They're just better than they might have been.
Definitely.
And that's been the story over the last 3 months. In the last few weeks, year to date, Euro Stoxx 50 is absolutely ripped. It's up by 8, 9, 10 percentage points. Do you want to be on board with that story? And the question I've been asking through this morning is how durable the tailwinds are. Is that a story that you think can play out through this year?
I was actually short the DAX in Q4 last year, and I closed the short in the early days of January this year. So I was hurt by that. And it's not a move that I've made to go long, but China reopening and the natural gas situation in Germany, I was worried there were going to be brownouts. I was worried you wouldn't be able to get the electricity you needed to manufacture goods, so a real manufacturing recession. And those have been alleviated, those risks pretty much. So I've not really gone long cyclical Europe yet, but I've closed my short. So I'm part of the reason I think the market's really jumped this year.
That's it, and that's what I want to touch on. There is a difference between shorts off and longs on. How much of the last few weeks is just shorts off?
Must be a big part of it. I think a lot of people in November, December talk about what's going to happen in the coming year, and you worry about risks, and there were real risks that have really dissipated. So I think it's not people really clamoring to get in on a structural rebound in Europe, but just closing positions that we're betting against something really severe on the downside that's probably not going to materialize.
It's been a difficult market over the last 12 months, that's for sure. Patrick Armstrong of Plurimi Wealth. Tom, navigating some tricky issues, but I've got to say, let's pick up on that short of Amazon. That one stands out for me.
It really stands out, John. It's going to be fascinating to see after the way that Microsoft is going down this morning. John, it has been a grind. And again, as a ginormous country at 8:10 Wall Street time, let's be clear, folks, Microsoft has not found a bid this morning. There's no other way to put that. And John, I think it's sport to say the least. John Ferro in London there, and of course he's getting ready for more conversation, and importantly his 9 o'clock hour as well. Lisa, I want to drive back to what you earmarked, which is the unusualness of a vice chairman of the Fed, a quote-unquote top contender to take over the desk position at the National Economic Council. This is the position Gene Sperling had through Obama and Osama Clinton, I believe, as well. Someone will go, well, this is a demotion. And maybe in modern Washington, it's not a demotion.
A lot of people would say that this is not a demotion. She's currently number 2 at the Federal Reserve. Lael Brainard, we're talking about, the Fed vice chair, who is number 2 to Fed Chair Jay Powell. And she's being, we're reporting both in Bloomberg as well as the Washington Post and others, that she's a front runner to replace Brian Deese as the head of the Chief Economic Council for President Biden's administration. What this means in terms of who fills her role, huge question.
And also, with eyes to Secretary Yellen, if she steps aside, is this just a stepping stone for anyone, including the vice chairman? The politics, the intrigue of Washington. Stay with us through the week for that. Futures deteriorate -33. This is Bloomberg from London, from New York.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany will provide Ukraine with a significant upgrade to firepower to use against Russia. Berlin has confirmed that it will initially supply the Ukrainians with 14 of its Leopard main battle tanks. The first German tanks will deploy to Ukraine in 3 months. The Biden administration is expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. And as you've been hearing here on Surveillance, Bloomberg's learned that the vice chair of the Federal Reserve, Lael Brainard, is the top contender to be the next head of the White House's National Economic Council. President Biden has not yet made a final decision. Brian Deese has been in charge of the council for 2 years. He hasn't given a date for his departure. Senate Majority Leader Chuck Schumer is telling Republicans, show us your plan. Schumer and other Democrats want the GOP to offer a proposal for raising the debt ceiling and avoiding a default. House Speaker Kevin McCarthy and other Republicans are demanding spending cuts in exchange for increasing the borrowing limit. Boeing ended the year by posting a quarterly loss. The results underscore the work Boeing still has to do to return its factories to full speed and fully capitalize on soaring demand for air travel. Still, Boeing's cash flow was better than expected, thanks to a flurry of jet deliveries. And AT&T forecasts profit and free cash flow for this year that missed estimates. It's another signal that high costs are hurting prospects for the wireless industry. Mobile growth was better than expected, with AT&T adding 650,000 new subscribers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We've got to live with the ups and downs of equities markets, and we've had 3 rallies in excess of 10% since the Fed started tightening. The real rally, the turning point for the economy, the beginning of a new recovery is likely to begin this year.
Stephen Whiting of Citigroup. Nobody links profit models into economics like Steve Whiting. Dana Peterson to join us here in a bit. Here we'll look at the American economy, getting ready for that look back, good GDP report of last quarter. And right now, a little bit rocky. Lisa, I've still got to go back to the 2-year yield, 4.14% speaks volumes. It's not the best chart I've ever seen, but it is a grinding lower 2-year yield chart.
Yeah, I do want to bring you this headline that just came because we've been talking about this all morning, the New York Stock Exchange and what happened yesterday at the open. They're saying now that the root cause of yesterday's open issues were manual error.
So that's basically like the same guy that was at the FAA went over and worked at the New York Stock Exchange.
So who gets fired, right? I mean, basically someone pressed the wrong button. They said that it's involving disaster recovery configuration. There were some short selling restrictions that were put into place erroneously. I find this fascinating because it really raises this issue, which you've been talking about for a long time, of the electronification of markets and the vulnerability if there's
the vulnerability of it.
Keystroke.
And, here's the answer. At home, if I'm lost, I dial 1-800-AFTERTHOUGHT, and she comes in and fixes it in a heartbeat. That's the reality. Why is the New York Stock Exchange any different than the Keene household? If I can't get the printer to work, who do I call?
This is now a public service announcement. If you're a tech professional and you've been laid off, contact 1-800-TOM-KEENE. He will hire you.
I just, there it is. Manual error involving disaster recovery. What was the disaster besides, I believe Morgan Stanley went down, what was it, 13%?
Yeah, and you saw Wells Fargo go down 11%. I mean, you're talking big market caps, big moves, and some real questions that need explaining.
Right now, we're going to have some fun, and it's also serious fun because we're all fixated on Vienna or Riyadh and the rest of commodities. And what we can do is we can go 3, 2, 1 refiners. Will Kennedy does that, as well as our charmed Javier Blas in his acclaimed book. And Will, I thought Javier wrote one of the most important essays I've seen in ages in hydrocarbon. It was a primal Blas scream, pay attention to refiners. Why should we?
Because the refining margins, the refining market look really tight at the moment. Last year, refining margins really spiked to unheard of proportions. One of the reasons that gasoline and diesel prices went so high in the US, it wasn't all about the price of crude. That fell away in the latter part of last year, but as Javier wrote yesterday, it's starting to come back. The amount of money that refiners will make processing a barrel of oil, and the 3-2-1 you mentioned is you get, for every barrel you get 3 barrels, you get 2 of gasoline and 1 of diesel, and you measure the spread on that. And that's now back at $60, and it's not up to last year's levels, but it's historically very, very high, and it means that if you're looking at crude, you may be looking at the wrong place, and it's a signal that gasoline, jet fuel, diesel, what you pay to move around is going to start rising again.
Will, I've got a gallon of gas in the United States. Of course, the great plunge for us, Will, $5 a gallon down to $3 a gallon. We've come up 12% as well. And I get the refinery tensions that are in America. With the war in Ukraine, has not in my backyard changed for refining in Europe?
This is the other huge story in refining this year. So on February the 5th, we get Europe's sanctions on Russian diesel. Now, obviously, they've already stopped importing Russian crude, but the diesel and other products could be a big deal. Europe has historically relied on Russia's refining capacity. It has far too much refining capacity for its own needs to supply it with diesel, and we use diesel to move our cars in a way that the US doesn't. And stopping that will be a big deal, because whereas Russian crude has found new markets in Asia, it's much harder to see those new markets for Russian products in Asia. Asia already has a big refinery sector. It doesn't import products. So the discounts to attract those barrels into other markets are going to have to be huge. And if it doesn't happen, some of those products will stay at home, and it could really be a problem for Europe. And so that's the other point of tension over the next few weeks, is what happens to diesel prices in Europe after those sanctions come in on Feb 5th.
Well, let's just zoom out for a second, because so far the theme of 2023 has been a new bid into crude with China's reopening, with this belief that perhaps we're going to avoid some sort of significant recession. Have you ever had a time where there's less certainty around the push-pull of both recession and the increase in demand from a China reopening?
I think it's a really good point, Lisa. I do think that people find it hard to gauge which direction things are going to go this year. Obviously, a severe slowdown in the wider world could really be a blow to oil and other commodities. But I think on balance, people put together the China reopening, the continuing issues for refining and sanctions that we've just talked about, the lack of new supply coming up on the world, the fact that the shale boom is really starting to fizzle in the US, lack of investment in the industry, and people put that together and have a fairly bullish outlook. But clearly, if the slowdown is sharper than some people are predicting, then that could upend that opinion.
Are the metals markets sending a different message from the fossil fuel, from the crude markets and the other fossil fuels?
I don't know if it's a different message. They are perhaps the standout performers so far this year. Both copper and aluminium are up more than 10% this year, which is far better than any other of the major commodities. And I think that, again, reflects a play on China reopening. Obviously, China accounts for about half the world's copper demand. A big investment splurge in China would be very, very good for copper. They continue to electrify the economy. And again, you have some of the supply side tensions that we described in oil. In Latin America in particular, there are problems with output in Peru and Chile. So it's a pretty bullish picture for metals too.
Quickly here, what's the view forward on OPEC? When's the next soiree in Vienna or some other geography that I'm jealous that you're going to?
Well, the next sit-down meeting probably won't be till June for OPEC, but they do have an interim meeting next week to discuss what they should do, just to keep an eye on the market, their monitoring committee, as they call it. I think our expectation is that they don't see any need to do anything new. They probably hold the same view of the market, that things look fairly stable, fairly bullish, and steady as she goes. So I don't think we're going to get, well, I feel silly for saying this, but I don't think we're going to get much volatility from OPEC in the next few weeks.
Will Kennedy, thank you so much. I got the Javier Blas essay out, folks, on Twitter. You can see it there, and of course through all of Bloomberg as well, at Bloomberg Opinion. Will Kennedy driving forward our hydrocarbon coverage. I'm as guilty of this. I've been guilty of this for a zillion years, Lisa. It's just so easy to get hooked on the upstream romance of exploring, and we're going to drill off Siberia and the rest of it. And you want to talk about a refinery in New Jersey? Somebody else does it. I don't want to look at that. I'm not going to read that 8-page report on Marathon or whatever.
Well, and, honestly, is this going to be something more discussed about as we potentially get the Strategic Petroleum Reserve, and what happens with them purchasing some barrels when it comes to the elasticity, because of exactly what you're talking about, the refining stickiness and the sort of lack of capacity there.
Well, the lack of capacity, and it goes to NIMBY, not in my backyard, and it's in full force in America. And you heard from Will there the nuances of a European NIMBY, which is to export it to Russia. That's done.
What I find interesting is that you end up with a number of analysts who keep saying they're bullish on energy stocks, regardless of what crude does, regardless of what prices do. And that basically they're minting cash, they're throwing it off, they're paying big dividends. And so there's more momentum behind that, regardless of the uncertainties that we heard will try to make sense of just there.
Well, it'll be interesting to see. What's interesting is futures deteriorate. Negative 33 is now negative 37. Dow, negative 246. Dow, midpoint between 33, 34,000. The VIX, with that interlude at 19, comes to the angst of 20.12 as well. What am I focused on? It's got to be the deterioration in the 10-year real yield. Disinflation in order. Stay with us from London, from New York. This is Bloomberg. Bloomberg Surveillance, we say good morning to you here. Economic date at 8:30. There is none, so we'll move forward here today. We're going to talk about Canada here in a moment, but I do want to get out the calendar on earnings, and please stay with Bloomberg this afternoon for a slew of earnings out on radio, on television. Our team will climb on board that and give you the trends. Like Microsoft yesterday having a challenging day with futures, negative 35. And then there's Canada. Lisa Abramowicz with me, who's expert here on the collapse of the Montreal Canadiens, and also it's like a big deal what the Bank of Canada is going to do.
Well, only because they were out front last year when they were hiking rates at a faster clip than the Fed or the European Central Bank, and now they're expected to be the front runners, the leaders in shifting down, the step down to 25 basis points. So that comes at 10 a.m., and that's basically where the currency is trading. The Canadian dollar seems to be sort of pricing in that there will be that shift lower, and that they probably won't give a more dovish kind of a message at the press conference.
It's going to Bill Curry writing it up in Ottawa. I can never pronounce it like the Canadians do. Totally different than us. This is the Globe and Mail with one of my favorite people, which is David Dodge of Princeton, who was the giant former Bank of Canada governor. And he just says simply, you're underestimating the risks of a recession. It's the same debate as here, but they seem to be having it quicker, sooner than we are.
And they were last year, too. Yeah. So how much of a signal versus noise will it be? And a lot of people are watching the Bank of Canada, and you can sing Blame Canada or whatever you want to do, but they are out front in really creating this debate.
That sounds like a great screenplay you could write.
Thank you.
Blame Canada.
Have you ever heard the song?
No.
I'll send it to you.
It was #1 in Fargo. We'll move forward. The future's negative 36 to my most anticipated conversation of the day. No, not John Ferro on dining in Mayfair, but with Dana Peterson. She's chief economist at the Conference Board. And this is a conversation, Dana, I haven't done this in ages, about the economy right now. What tea leaves do you look at to know where we are the third, fourth week of January?
Sure. Well, we look at leading indicators, our own measure, which continues to signal that the U.S. is probably entering into a recession right about now. I know some people have doubts about the measure, but it's done a remarkable job in signaling recession before you have GDP, before the NBER even says, hey, we had a recession in the past.
I mean, I look at the U.S. leading indicators, and you guys on the high ground on this. What's a leading indicator right now? I mean, what are you looking at? Starbucks coffee sales? What are the tea leaves that are leading in the leading indicator Conference Board statistic?
Well, certainly housing permits are slowing, and that's an indication of the Fed's rate hikes working, slowing down the housing market, which is definitely a source of inflation through rents. We're also seeing consumer expectations be quite weak. New orders for goods are down. A number of the other indicators, certainly the financial market indicators, are showing some signs of stress and weakening. Just about everything is worse within the leading indicators, and it continues to suggest that, yes, we are going to have some kind of a recession. We still think that recession is going to be mild. It's going to be brief, but nonetheless, that's going to be the outcropping of the Fed raising interest rates close to 5% within a few months.
Dana, how do you push back against people who say that short and shallow is the new transitory?
Well, I guess you could say, going back to the whole transitory discussion, you really can't blame the Fed too much, right? They didn't know the pandemic was going to last 3 years. They also didn't know that a war was going to break out and cause supply side factors in terms of inflation that haven't dissipated. Still, when we look at food prices, they're still being determined by things that the Fed can't control. And certainly, I think the Fed didn't anticipate as big of a run-up in housing prices that are feeding through rents and keeping rents sticky. And so I think that, I'm a little bit more sympathetic to the Fed. And when it comes to recession, it's art as well as science. And I think that, our measures are still telling us, yes, there's going to be a recession. We're seeing momentum slowing. We'll get a GDP data tomorrow, but more importantly, the monthly PCE data, which will tell us what's going on in services. And we'll also see what's happening with inflation. It's still very sticky, and the Fed still needs to raise rates to bring down inflation.
Dana, before we go on with the economic picture, I want to stop for a minute. And we've been talking all morning about the potential for Lael Brainerd to leave the Federal Reserve as vice chair of the Fed to go to the Biden administration. From an economic perspective, does that change the calculus in terms of the differing views on the Federal Reserve?
Well, we need to think of the FOMC as a group of people, many opinions, and when we look at the SEP, the Summary of Economic Projections, and the dot plot, it's a collection of those opinions. Certainly, the dots may shift a little bit left or right, up or down, with one of the governors leaving. But the thing is that you'll have another person coming in, and that person's opinions will also factor in.
Dana, I'm going to get you in trouble here. Are the dot plots of the Fed more informative than the Conference Board leading indicators?
I think they're both important. They give different measures. I mean, the dot plot is essentially telling us where FOMC participants think the federal funds rate is going. Our LEI tells us where we think GDP is going. Two different things, but still both important.
I mean, it's both important and all that. I'm busting her chops, folks, because the leading indicators was religion here a few years back right now. And I agree with you, Dana. It's not that people push it aside, but it's just been overwhelmed by all this other data. Is auto sales a leading indicator? Is used cars prices, things that really matter to our listeners and viewers? Is a dozen eggs a leading indicator?
Well, the thing is that, we try to keep it neat and clean. We have 10 things, but we do always, every year, review what's in the basket of indicators, or the leading indicators index. And we just don't look at that. We look at everything else. Certainly, we're concerned about things that aren't necessarily in the leading indicators, like trade and inventories. And so we're concerned about all those things. A good economist will look at everything and not just rely on one source.
Dana, a lot of people are discussing and debating pretty intensely whether inflation's already slowed to 2% and whether the Fed's already achieved their goal. They've killed off this potential acceleration. Where do you stand on that, especially with the potential for some sort of acceleration with respect to oil prices?
Well, when I look at the components of inflation, certainly energy prices have come off dramatically, but there's still that risk that there's a resurgence once China reopens and there's greater demand for energy. Certainly, as that country looks for more oil and natural gas. However, things that are still sticky that the Fed hasn't been able to tackle are food prices, both food at home and at restaurants, and food outside of the home. And then rents. Rents or shelter costs are the biggest thing driving inflation, core inflation right now.
Well, I don't want to interrupt, but this is the heart of the matter. Everybody listening and watching to this is going nuts when you say the Fed can't manipulate out a dozen eggs or the price of a 3-bedroom in Cleveland. You've got a model of under 3% inflation forward. Is a dozen eggs and a 3-bedroom rental in Cleveland, are they going to come down so you can get to your 2.x% inflation rate?
Well, I have less confidence about the eggs than I do about rents. Rents are a reflection of what happened in the past with home price valuations. We see home price valuations for new and existing homes are coming off. They're slowing very rapidly, and that's going to show up in rents ultimately. It takes a while from the peak of where home price valuations were to where you actually start seeing in rents, it could take 12 to 18 months. So if it's around 12 months or so, then we're looking at the spring of this year when we will see material slowdown in rents that will help bring down core inflation and consequently overall inflation.
Before we let you go, there was a story that caught my attention about Walmart. They've been trying to compete with some of their rivals and have been raising the prices, so they're raising the wages for their hourly workers now to $14 starting next month from $12, still less than over at Amazon, Target, and Costco. How much wage pressure is there that you see percolating up, not for necessarily office workers, but for the people who actually go out and make the economy work in day-to-day kinds of positions?
Wage pressures have been tremendous in those jobs where you actually have to physically show up for work. And those are also the industries that are suffering the biggest labor shortages. Anything that's experiential, like going to Walmart or going to the movies or going to a restaurant, those are all the sectors that are still struggling to find workers. And so the first thing that companies do, and we even canvass them, is to raise wages, add benefits, all things that cost them money. But it's what they're doing to not only attract talent, but to keep talent. But unfortunately, those higher wage pressures get pushed down to the consumer, and that's also leaning against what the Fed is trying to do.
Dana, thank you so much. Just a terrific brief. Generous of your time here. Dana Peterson with us with the conference board. You know, I haven't looked at the eggs because you and I are fancy people.
I'm not
we go
fancy.
in and I got a limit where I shop of 2 dozen eggs. I don't know about people out there. We all got our stories. Moonshot, summer of 2019, eggs are up 257%. This year alone, 2022 calendar year into the new year, eggs are up 148%. So what I'm paying for eggs, I think, is cheap. Like the price at grocery hasn't gone up as much as wholesale eggs.
Margin pressure, right? Because basically this is the biggest pushback that you get from consumers who go and buy eggs, and they don't want to spend $7 for a dozen. They want to spend $4 for a dozen. So they're going to keep spending $4 even if the price ends up going up for the people who actually are managing them.
We should point out there's some medical stuff in here, like the avian flu and all that. This is not just economics and like what we were talking to Ms. Peterson about. There's some medical, flu stuff here.
Do you check your eggs before you buy them? Do you look at each one to see whether they're cracked?
For those of you internationally, we go to the third rail. I check my eggs because they're so often they're broken.
Which is the reason why it's actually helpful. I always open it up, and then often the ones that are clear, you can just sort of like hold them up and look at the bottoms.
I open them, but do you open the corn and the cob before you look?
That's tricky.
My mother would get so angry at the people opening. She was a Midwest girl.
Yeah. Oh, I know. And this is a real huge debate.
And the people, the snide East Coast people, if my corn cob isn't perfect, I'm going to sue someone.
You've seen people actually shear the corn.
The whole thing off. I don't like that one.
In the grocery store, throw it in the garbage can and toss it aside. Another level of, disrespect. Corn disrespect is something that's very, very hard in our family.
Stay tuned. Farm Journal with Lisa Abramowicz. Look for that this weekend, 6 a.m. Futures deteriorate. They're going down because they don't want to hear about corn and eggs.
Evidently.
Negative 41 on futures. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and Germany have overcome a disagreement that threatened to fracture Allied unity. They've agreed to give their main battle tanks to Ukraine. Germany confirmed today that it will send 14 of its Leopard tanks to Ukraine, and eventually there will be more. Meanwhile, the Biden administration is expected to announce as soon as today that it will offer Ukraine the M1 Abrams tank. In China, Lunar New Year travel and movie box offices are showing signs of recovery. In the first 4 days of the holiday, the number of trips was up over last year. Meanwhile, the number of movie tickets sold was higher than in 2019 before the pandemic. Google says the U.S. Justice Department is doubling down on a flawed argument by suing the company on antitrust grounds. 8 states joined the federal government in calling for the breakup of the search giant's ad technology business. The suit claims Google has illegally monopolized the digital ad market. Bank of America is rewarding its majority of its employees with a pool of restricted stock. It's an attempt to retain workers in a gloomy economic environment. About 96% of BOA's global workforce is eligible. It's the 6th time the company has offered such stock awards. And Boeing ended the year by posting a quarterly loss. The results underscore the work Boeing still has to do to return its factories to full speed and fully capitalize on soaring demand for air travel. But still, Boeing's cash flow was better than expected, thanks to a flurry of jet deliveries. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
I think there's a mindset within the white business community, and to some extent in the country at large, is that this definition of equity and diversity ought to see money flowing, capital flowing into black entrepreneurs for investment and startups of business. And I think if it were easy, you would see more Bob Johnsons, more Michael Jordans, more Magic Johnsons, and Oprah Winfrey's and the like.
He is Bob Johnson of BET, the founder, and RLJ Companies chairman, in conversation with David Rubenstein. This is one of the great American stories. This is a kid who was near youngest of 10 children, and he did that thing that can happen. He was so damn smart as a young kid. He was crowbarred into the University of Illinois on his way to Princeton, and with great acumen onto creating value and money in media. It is David Rubenstein's show tonight. Look for that at 9 p.m. in New York. And Mr. Rubenstein joins us this morning from Chicago. David, Bob Johnson was first in early. Why aren't there more Bob Johnsons?
Well, his view is that the white community, the white business community, gives a lot of lip service to helping black entrepreneurs, but in reality, very little money shows up from the white business community into the black entrepreneurial community. So Bob Johnson was the first black billionaire in the United States, and after he built BET, Black Entertainment Television, he subsequently bought the Charlotte Hornets and ultimately sold it to Michael Jordan, who now owns the team. He's a very wealthy person, very smart, very politically connected, but his view is that the white business community is probably better at lip service than actually reality in helping black entrepreneurs.
To be delicate about it, you live this every day at Carlyle, as we do at Bloomberg. The modern finance system co-opted black innovation. I mean, that's really what this comes down to. How do you see, David, that we nurture this forward to develop more Bob Johnsons?
Well, you've got a 200-year-old problem you're not going to solve overnight. I think there has been a lot of progress in the last few years and much greater emphasis on diversity, equity, and inclusion. But you've got a 100-year, 200-year bias that's going to be difficult to overcome. So there are going to be more Bob Johnsons, and there are other Bob Johnsons. There are more than one black billionaire now, but still relatively small compared to the population.
Well, Bob sold BET to Viacom back in 2001, and he sold it at the time for $3 billion. Can you give us a sense of where the valuation would be, whether he has regrets about selling it there, since there is a huge audience and it has grown since then?
Well, he had two great assets. One was Black Entertainment Television, which he sold for $3 billion to Viacom, and netted maybe for him and his wife about $800 million. And with other things, he became the first black billionaire. Today, cable prices are way down, and cable values are down because of a whole variety of other means that people watch their news and their entertainment. But the other asset he sold, unfortunately for him, became much more valuable. When he sold the Charlotte basketball team, I think he sold it for maybe $300 or $400 million, $500 million. Today, each of these basketball teams in the NBA is probably worth at least $1 billion, if not $2 billion. So he probably sold that asset too soon.
But Bob Johnson is, as you said, still very powerful and very well off as he makes inroads. I'm curious whether he actually believes that there is more of a comfort discussing race among business leaders at this time and how to actually grapple with, as you say, David, a 200-year problem.
I would say that Bob is not wedded to any corporate existence right now, and therefore he can be very free in what he talks about. And he would say, no, there's really good lip service being given, but he doesn't really think the white business community is as interested in helping black entrepreneurs as the rhetoric is. So he would say it's going to take a while for you to have black entrepreneurs like him more prevalent in the United States.
David, I'm absolutely fascinated, and particularly with your study of history and your philanthropy to America and some of the documents you've brought in and such. You mentioned the media companies coming out of the Bob Johnson era that are now basically flat on their back with technological disruption. How does Carlyle play that? When you sit around with your young Turks at Carlyle and you say, how do we be opportunistic in media? How do you actually go through that process?
Well, the kind of things that we looked at Carlyle years ago, cable TV properties and things like that, are just not as highly valued or as attractive to buyers. So you have to find new areas, new technology areas, and try to get in on the ground floor of them. But the kind of things that Bob Johnson built, BET, is just not worth as much today because people don't really look at cable as much as they used to. They look at other means and streaming means. But a cable channel like BET today, I doubt if it would get anywhere close to the value that he sold it for.
I mean, not that I need to know your last phone call with Mr. Iger and Disney of what they need to do, but David, you and I have never seen technological disruption like streaming. Okay, so private equity can run from that. What does the rest of the finance industry do? Where are they in 5 years?
Well, no one, of course, can know for certain, but I think right now a lot of technology that's being developed in Silicon Valley and other parts of the country, you have venture capitalists and you have what's called growth capital investors putting money in, and they're making bets. They don't really know which technology is going to take off, so you make several bets. Nobody would make just one bet in technology for the future. Who could have predicted streaming 10 years ago? No one, probably.
Yeah.
And as a result, everybody is wary of just making a bet on one technology. We just saw the other day that Microsoft is making a multi-billion-dollar investment in essentially an artificial intelligence startup. Who would have predicted that a couple years ago? And so no one really knows, and the theory is make as many bets as you can that are reasonably intelligent, and one of these technologies probably will take off.
One interesting aspect of this is the new asset classes that have sprung up, and you were talking about the potential for sports teams and Bob Johnson. That's long been established. There was a Financial Times story today talking about how music financing is the next big thing, and actually having futures attached to different streaming rights. So actually cling onto the IP of some of these musicians. Are you buying that?
Well, I do think that music technology has changed dramatically, and now the great recording artists are selling their programming or their recorded albums and so forth and songs at great valuations, because now through streaming and other devices, people will be able to pay a little bit of a tiny fee, and you'll get to hear all the music you want. And as a result, I think it's a changed the entertainment business completely and changed the record business completely.
Can you see David Rubenstein taking a meeting with Justin Bieber?
100%.
I could just see it.
Absolutely.
Well, we were involved in that for a while.
Okay, well, thank you, David Rubenstein. Thank you so much with Carlyle. And, of course, the news here that Mr. Bieber, some kind of reports that he's moving his catalog out. The number 200 million has floated to the surface recently.
And this is sort
That's
of
a
new.
lot of Biebs.
It's sort of new and also sort of not. Remember Bowie bonds back in the day?
Yeah, well, they started it. No, David Bowie started
David Bowie was
it.
a pioneer with this.
Pioneer.
In a lot of ways, he was a pioneer.
Yeah, and that's, of course, becoming more often the case with the cash flow persistency of some of these copyright items. David Rubenstein with Bob Johnson tonight of BET. Really, really interesting to say the least. I think we've got to look at futures negative 44, deteriorating. We're in earnings season. We're going to see that. But I would really suggest to people it's not just the equity markets. There's a lot going on out there in terms of beginning to model in off of what we'll see tomorrow, which is just under 3% GDP.
Have we gotten to a point where bad news is bad news? And I mean necessarily, glass half empty, but in terms of a negative view on the economy will bleed into equity valuations. We're seeing both bond yields lower and we're seeing stock futures lower. And we've seen that kind of correlation that's more traditional kind of reassert itself a little bit more in a couple days this year.
We've seen Evercore ISI reaffirm sub 3% inflation coming. Dana Peterson at the conference board, sub 3% inflation coming. And as an expecting force, the markets will begin to look out to that. And, the days are getting brighter every day. I know it's January, but March will be here in a cup of coffee. And I'm going to go to, or a cup of Tang, I should say. I'm going to go, Lisa, last meeting of the summer, July 26, at the Fed, where they'll be confronting, according to some of our guests, some serious disinflation. And that just leads to endless mysteries.
Are you on short and shallow camp?
Am I short what?
Short and shallow camp?
I don't play the game. I've been so humbled and so wrong over the years about gaming NBER recessions, which are really after the fact in their analysis. I do suggest that what we saw in 80, the Volcker years of two separate and distinct recessions close together, was very unusual. In these unusual times, it gives me some humility. John Ferro's in London. He's going to migrate forward with some important conversations, much more, on Bloomberg Radio and Bloomberg Television today. Please stay with us. This is Bloomberg Surveillance. Good morning.